Welcome back. Today we've got Tesla, Enphase, Google on deck. These are some massive earnings on deck today, and it's going to be crazy. It's actually kind of exciting, mostly because you're going to get a really good dose of what markets are going to look like, quite frankly, going into the second half of the year here. This is the big test. We want to see what's going on with earnings at Google. What is this going to mean for the rest of the Mag 5, I guess, since we got 2 of the Mag 7 reporting today. How's AI going? How's advertising spending going? Advertising spending is a big deal. You know, we saw what happened with UPS, and obviously some folks are buying different products than they've been used to, because UPS, even though it's recovering into the close here, down 12% on the day, 12.5%. Look at that. And you've had a severe downtrend on UPS really since, quite frankly, the end of COVID. If you look here, you go December 2021. That makes sense. That was sort of the top for everything. But look at that solid downtrend there. It's starting to look worse than the Tesla chart. Good Lord. Tesla's had a nice recovery, but then again, we'll see what today holds in store for Tesla. So this is going to be really interesting because UPS, for example, we talked about this on our course member live stream this morning. UPS is telling us people are shipping, like volumes are finally recovering, but unfortunately the type of volumes that are recovering are small packages. And small packages have substantially lower margins for UPS and revenue, quite frankly. So your revenue per package goes down. And what really happens is you end up in a situation where, yeah, people are buying maybe more Temu stuff, but they're buying cheap stuff. You're seeing a consumer that's more choosy with what they're buying. There were some reports that consumers are actually holding back on their purchases of things like paper towels, toilet paper, and Kleenex. I had no idea you could actually limit the amount of toilet paper you buy, but apparently some people are doing it just because things are tight out there. Things are a lot more expensive than they have been. And we're at this sort of cycle where, yeah, we're probably rotating to an environment that's going to face a lot of constructive deflation, which is good, right? Prices coming down, supply chains have eased a lot. So what happens then? You've built massive new supply chains, and you're able to compress the pressure on supply chains, which hopefully brings prices down for, quite frankly, everything. Not just cars, not just groceries, but everything. Insurance, rent, you name it. So we're in a great environment for new price discovery. Unfortunately, that can also reflect in earnings negatively because, well, frankly, your revenue growth year over year looks smaller. And even if you improve margins, because that top line gets compressed, you might be in a place where your EPS declines. And if your EPS declines, then what happens? Lower growth, higher valuation, higher PEG ratio. Not great. Okay. One sec. Okay, hold on. Okay, there we go. We'll see. Today's going to be that day where we get a lot of guidance. Usually what you find, OpenAI removes AI safety leader. Interesting. Usually what you find is NVIDIA's pretty late in the earnings cycle, and so you kind of get everybody else that goes first in the earnings cycle. And so anything that we could see in terms of how much is cloud revenue going up? Is cloud revenue still going up? Is the first thing that happens when it comes to a collapse in a cyclical like data centers and chips. What'll end up happening is you'll be looking for some form of slowing of growth in cloud compute. And it doesn't necessarily mean negative growth. It just means the growth is slower. And so if cloud compute collapses, I don't expect it would collapse, but I'm just saying when and if that were to happen, then you'll have less pressure to actually buy chips, and that ends up trickling to lower chip prices, balance sheets get written down, people get laid off. Our economies, they strive for growth and thrive on growth. There you go. So we'll see. Google will tell us. I'm really interested in what happens at Google Cloud. I just pulled up, and I'll throw this up on screen here. This is the last 10Q for 2024. We'll have this up in just a sec on Google. And it looks like Google Cloud rose from 7.4 billion in Q1 2023 to 9.5 billion in 2024, which is an incredible growth rate. I mean, if I take 9.5 divided by 7.5, I'm at about a 26% growth rate. Okay, well, a 26% growth rate divided by 4, I want to see about 6% growth on the quarter. So I'd want to see Google Cloud come in at, just over 10 billion. And so if it doesn't, we're going to see a slowdown in the pace of Google Cloud, right? So that's going to be something we're paying attention to. How are we doing on data centers? Obviously, Tesla. Tesla's going to be a big one today. Everybody's really curious. Hey, what's going to happen with Tesla? Tesla reports 10 minutes after Google, 5 to 10 minutes after. Tesla reports at 4:10. Enphase reports at 4:05. Google at 4:05. This morning, I put out a complete strategy for what my thesis is on Tesla, and we'll see what ends up happening with it. But let's go grab Tesla's last press release or their last financial statement. Actually, you know what? We'll probably go to their, what's it called? Slide deck. Their slide deck is usually pretty good. It breaks down some of the really important keys that we're generally looking for. And so worth noting that expectations right now are that vehicle gross margins are going to stay flat. I actually think Tesla can beat on this number, so I'm not as bearish as the market on this. However, it's worth knowing that the market is expecting free cash flow to explode to about $2 billion. And while that could be possible, the problem is you're pricing in a lot of enthusiasm on the free cash flow side. So we'll see. What you're doing is you're pricing in, the market's basically looking for free cash flow in the neighborhood of what you saw in Q4, 2 billion. And as we can see for the other, last Q2, we were at about 1 billion. Now, keep in mind, we did lower production in this quarter substantially. So Tesla's deliveries were excellent in Q2 with the interest rate promotion, which they've brought back, probably because as production caught up, they started seeing inventory build again. And quite frankly, once you introduce 1.99% financing, you're going to have a lot of pull forward, but I don't know how much, how many people are going to go back to being interested at 6%. So it makes sense that they've got the 1.99 back. But the other thing we're going to be looking for at Tesla is, hey, what is the accounting going to look like for this? How are we paying the discount points up front? Is that going to hurt margin? The answer to that would be yes. If it does end up hurting margin, then the question is, do we, how bad, basically? Because that might be the new margin that we get stuck with. And right now, Tesla's trading for a 3.1 peg, so it's a little bit on the rich side. Markets are expecting an 8% movement in either direction for Tesla. And then, of course, we've got Google and Enphase. I think the levels of support you're looking for, by the way, Enphase, if you get a really bad report here, you're going to go back to the high 70s. On Tesla, my opinion here is if you get a bad report, you're easily down to 230, and if you lose 230, you're down to 2. If you get a good report, you're pretty easily at 265. That's a pretty easy number. 270 maybe. What you really need or want is Elon to give some real excitement and momentum to get you going all the way to about 295. If you break through 295, that's when you can get into the 300s and you get into some of that that crazy those crazy numbers. So let's be clear, that's a peg of 3.1. I'm not sure if I said that correctly, but a peg of 3.1 on Tesla right now, and that's using forward earnings. Going forward about 4 years for estimates. So anyway, into the close, you've got a little bit of a recovery here. The Qs did rotate down. Personally, I'm a big fan of, if you're looking for a hedge, I like hedging with either trimming some positions and having cash to buy in a dip. The nice thing about doing that is you've got money on the sideline to go buy the dip, and it sort of helps you with the temperament in the event that you have sort of a correction. Unfortunately, a day like today, like what you really want is nothing. You want today to be really a nothing burger. You want these earnings from Google, Enphase, and Tesla to just be meh. They don't have to be really great, just as long as they're not bad. Because if the earnings start bad, like a UPS this morning, or like the airlines are facing, that's when you're going to start getting companies going, oh my gosh, we're going to get slaughtered in the stock market. We need to think layoffs. And layoffs make me the most nervous. So we'll see what happens there, because I think we're very, very close to a recession. And it's not going to take a lot of earnings to push us into a recession. So we want to stay away from that. So anyway, yeah, I personally, just to be transparent, I don't have, I don't like to trade earnings. I usually get screwed when I trade earnings. I did trade this morning. If you want all my buy-sell alerts, make sure you're part of the Meet Kevin Stocks and Psychology Money group. Just go to meetkevin.com to learn more. Pricing's going up soon. All right, we're about 10 seconds away now from the bell. And let's go ahead and listen to the bell, and then we'll be on deck for earnings. Here we go. Good luck, everyone.
On the way. That's going to do it for closing bell. We're sending it to overtime with Morgan Brennan and John Ford.
Well, that's the end of regulation. Enersys ringing the closing bell at the New York Stock Exchange.
That sounded like a really long bell. Anyway, somebody in the comments is asking, where's the YouTube stream? We're live on YouTube. It's on the main channel. You're welcome to join over there. Also live on TikTok and Twitch and X. Live everywhere. Shout out to StreamYard, metkevin.com/StreamYard if you want a paid promotion, affiliate link. Anyway, let's see here. We got the Qs down 35 bips going into the close over here. Let's check out the watch list. If we go over here to the post market over here, you've got Upstart up. Sorry, not the post market. I want to see what happened on the day. Spotify was up about 12%. Holy crap! Embraer? No, it didn't. How is Embraer up this much? Is that true? It moved 8% today? Are you kidding? Yeah, it's almost at $30. That's crazy. ChargePoint, ARM, that's incredible. These are some incredible moves over here. Small caps did pretty well today. Bitcoin didn't, so you had that 2x leverage. Bitcoin was down about 8% today. Bitcoin down at about 65.5 now, which is lower than when we heard the Biden resign. You had 204 here % down on Tesla. So you've already had a little bit of a sell down on Tesla there. Some people may be trimming going into earnings. Really looking for that confidence here. So we'll keep an eye on probably Google first, actually. Google will be first up along with Enphase and then Tesla. So we'll kind of, if you type them in here on Webull, you'll always have them sort of at the top if you sort by recently viewed rather than a list. I like having recently viewed up. So anyway, we are now on deck. First should be Google, and then we should be looking for Enphase. And Tesla's going to be last out of these three at 1:10 p.m. So let's go take a look at the expected volatility on Google. Keep in mind also the volatility is above average on Tesla, so options have been very, very expensive on Tesla. Looking at about a 5.7% movement expected on Alphabet, and if we look for Enphase, let's see here, Enphase earnings. The movement on Tesla is expected to be 8, Apple's expected to be 5.75. Enphase is looking at a potential 11% movement. That doesn't surprise me that you've got some higher volatility there on Enphase. Okay, Google is in. Google EPS beat 189 versus 184 expected. Ad revenue beat 64.62 versus 64.53 expected. Operating income beats. Good job. Oh, cloud. Good job. Cloud comes in over 10. What did I say? You want it to be over 10? It comes in at 10.35. Beats estimates. YouTube ads revenue misses 8.66 billion versus 8.95. I've been cutting out some of the ads on the videos here. Sorry, folks. I haven't been feeding you as many ads as usual, so YouTube's revenue's down. But anyway, then you've got, let's see here. So YouTube ads missed. Google Cloud beat. Operating income beat. I want to see forecast. Announced a cash dividend of 20 cents. Let's see if there is a forecast. I don't have one up just yet, but I am seeing the stock move down roughly about 3% here. Still waiting for Enphase and Tesla, of course. But in the meantime, let's get into that Google investor relations page just to see what we've got going on here. Google Investor relations, yeah, you can see Google ticking down a little bit more. Tesla comes out. EPS 42 cents. That's earlier than expected. Wow, free cash flow missed. That was a high bar. It was a $2 billion high bar. It comes in at 1.34 billion. Adjusted EPS misses 52 cents versus 60 expected. Revenue actually beats. This makes sense that the top line beat 25.5 versus the estimate of 24.63. However, operating income missed at 1.61 billion. That's probably because they're writing off the advertising expense for the loan buy down. It's probably going into SG&A. Gross margin actually beats, comes in at 18% versus 17.4. That's actually pretty good. Okay, this is not good. Tesla still sees notably lower volume growth rate for 2024. Focused on company-wide cost reduction. Plans for new vehicles remain on track. No, this is interesting. Plans for new vehicles on track for production in first half of 2025. So that might be something that sort of props up markets a little bit. People get excited when they hear, development for next vehicle. So shareholder deck isn't up yet. So we're just kind of looking at the feed here, but we'll pull up the shareholder deck as soon as it's up. Again, not up right now. So still looks like Google's now going positive. Oh, that must be off of forecast. So I'm going to try to see if I can get a forecast here. I'm really looking for a cloud forecast. That's the big one there. Google Cloud. No, I don't see a forecast yet from Google. Let's see if I can type in Q3. No forecast given here. It's probable that you're going to get those on the earnings call then. So Google Cloud does beat though, so good job. And it is contributing nicely to the bottom line, $1.1 billion to the bottom line versus just $395 million previously in the quarter. And this is with fewer employees. You've got about 2,000 fewer employees than you had last year at 179,500. And again, Google Cloud sort of beating on that growth rate on the quarter, which is very, very good. So I like to see that. Waiting. Okay, Tesla shareholder deck is live now. Let's go ahead and pull up the shareholder deck, see what we've got. So, okie dokie. There we go. And throw this in here. Okay. So, first thing I want to look for is right here. Look at that. You got it up to 18%. My expectation was that you would have really needed this to be about 20% for markets to be very, very excited. I didn't actually expect it would go to 20%. I was just saying I didn't think you would get very excited off of margin. I think really a lot of this cycle is going to come down to people's expectations for what's going on with those future cars. So I'm going to just look for that word future right here. And so future planned capacity, this is with FSD, that's fine. Trying to show this sort of exponential growth curve there with leg ups. That's something you would expect. Looking ahead towards the future in autonomous and driving robotaxis, we continued progress on software and hardware development. Optimus is performing its first tax handling batteries. I mean, this basically just means sort of like probably moving batteries from one box to another. I'm not highly enthused that this is very, how should I say, commercial ready in terms of flying off the shelf here. Let me quickly get a Dropbox loaded so this syncs. The south extension of the Giga Texas is nearing completion and will house our largest cluster of H100s yet. Yeah, and then remember we did divert some of those other H100s as we sort of maxed out. Free cash flow, again, positive, which is very good, but missing some of those expectations, those high expectations markets had. I didn't like that expectation this morning. I was saying, at one point, I even said it early on the live, like, $2 billion is a little rich on expectations there. So preparation of the semi-factory continues, expected to begin production by the end of 2025. Cybertruck production more than tripled from quarter over quarter and remains on track to achieve profitability by the end of the year. That's really good. That's fantastic. That does mean you're still actually hurting margin. So in the earnings call, we'll probably see margins X Cybertruck, and those could actually be approaching 20%, which would be very exciting. I'd be looking for that in the earnings call, and I'd be very excited personally to see that. I've been using the X Cybertruck margins as well because I know obviously margins are going to be lower for something that's just starting out its RAM. In Q2, we achieved record quarterly revenues despite the difficulty in the operating environment. The energy business set a record there with 9.4 gigawatts of deployments. And remember this was almost more than a double here. What I'd really like to see are the margins. So let's go down to the revenue statement for a moment, and let's see if we could see any margins on where did those costs go from advertising this lower rate. So obviously vehicle sales blew up over here, which is totally what you would expect. Services, looks like services were positive, so we actually made money on services. Nominal contribution, you don't really expect that to contribute much. And it also looks like energy storage generation had a pretty good margin. You had, yeah, you're about 25% on energy. So I'm gonna write this down. That looks like it's 24.5% energy margin. That's very good, and that's gonna be here, here. Then SG&A, I don't actually see a big bump on SG&A here. You can see these are the sales, general, and administration numbers. These actually went down, so the buy down's probably not here. This is not where you're gonna find it. The buy down's probably amortized out because I'm not seeing it in the costs so far. Sales, costs of revenues. I mean, margins. Well, let's try to understand these costs right here. I mean, this was our gross vehicle margin, which they already gave us, and they moved up. So margins moved up on more vehicles. So I'm not sure where it is buried. It's possible they're depreciating it out. Let's take a look over here and see if there's any excess depreciation that we have that we can sort of try to pinpoint to. Don't see it. Deferreds on Canada. These are all your add backs. No, nope. Okay, so we'll see if the earnings call sheds some light on where they threw some of these expenses for buying down the loans. I don't see it at the moment, but that's okay. Could be buried somewhere, or maybe they just fired a bunch of people, and because they fired people, that could be, unless it's covered by firings, right? You lower your payroll expense, then you don't have this issue. It should be in cost of goods sold, but there are different ways that you can do this. See, companies like Ford, sometimes what I've seen is they'll throw some of the advertising expenses, including sales incentives, into SG&A. So I'm going to write this here. Sales incentives like dealer credits or rate buy downs can sometimes be included in SG&A, which then misleads people on the top line vehicle margin. So if I were an analyst, that'd be something I'd be asking. I'd be asking, hey, where are we hiding these numbers right now? I mean, not that I think it's a bad thing. I just want to know how much it costs. Like, how expensive is it for us to keep these interest rate buy downs going? Because that's what matters. Because right now, to induce demand, you really need interest rate buy downs. People are tired of paying the interest rates that we've seen thanks to the inflation that we've had. So I don't blame this at all. Okay, so we'll go a little bit more in order here of the presentation. So we'll go back to the top. But those are some of the things that I'm looking for. We saw sequential rebound vehicle deliveries, as well as overall consumer sentiment improved as we launched attractive financing options. Exactly, to offset the impact of high sustained interest rates. We recognized regulatory credits. See, they don't tell us where those attractive financing options are. Again, I expect that'll come up in the call. I haven't seen it in previous 10Qs or 10Ks either, so there's a lot of speculation about where those credits are. Total EV penetration returned to growth. That's fine. Progress continued on our AI initiatives. Reduced the price of full self-driving, which this is also wonderful. I'm a big fan of reducing the price of FSD. Frankly, I think you could get to a point where you just sort of include it in every vehicle. Oh, it looks like Enphase, by the way, it's moving up. I'm just going to briefly look at Enphase. Enphase up about 6%. Maybe we finally hit a bottom there. Enphase Q2 misses. You've got shipments missed. The Q3 forecasts missed. Q3 revenue missed. Adjusted gross margin beat. So literally everything missed except margin. I think what you're finding at Enphase is the stock's actually not it's not going down. The stock's actually rising after these earnings. It, to me, is a little bit of a signal that maybe you've hit the bottom on Enphase, right? It's just had so much pain for so long. So you're probably looking at something like $113 tomorrow, and then you'll be in that range of 113 to 109. That'd be my take over here. So that's again, this reaction, in my opinion, is, oh, thank God, it's not another 30% miss. We can go back to buying, right? So I think that's what's going on over here at Enphase. Okay, well, let's keep going here. We expect to see an increase in FSD attach rates for our fleet. That's fine. A company-wide cost reduction, reducing our cost of goods sold, traditional hardware, blah, blah, blah. Concurrently managing our product portfolio, maximizing our base. That's fine. Cybertruck became the best-selling EV pickup. I mean, frankly, there aren't that many EV pickups, and you've got your competition slowing down on these, so this is not a horrible surprise. If you got year-over-year automotive revenues down 7%, we generally don't like to see that. And take a look at this EPS decline. This is pretty bad, right? Your year-over-year EPS decline is down 46%. So, unfortunately, you're in a hole this year, but we know that. This is like old news at Tesla. Like, we know 2024 and 23 and 22, these 3 years of pain, really just a big reset of pain, unfortunately. So, let's take a look at the revenues here. Decline in, look at that. Reduce sexy average vehicle selling price due to pricing and attractive options. So they take it off the top. Now I respect that. That's fair. They take it off the price of the vehicle is what it looks like. Now I want to verify this, but looks like average selling price takes the hit. So that is interesting. Let's see if we can calculate that out. Okay. So, production, deliveries. Okay, here we go. So we're going to take 422, 405, and then we're going to take the revs, and we'll get average selling price. Total automotive revenues, 19,878. That's going to be 1,000, so I need million, billion, and then I need to divide those. That's going to put me at an average selling price right here of 47,059 is your average selling price. And let's take a look at what the average selling price was in the prior quarter. So the prior quarter we had 17, let me keep all those zeros. Oh no, I can't. 17,378, 1, 2, 3, 1, 2, 3. I need one of those keyboards that you have at like the bank where they have 3 digits on it. So last quarter we were at 4. I mean, this should be lower. Hold on, let me see. Wait a sec. 410. Make sure I'm doing this right. That's not right. 433. This was. Oh, that. Sorry. I need to be careful. Yeah. That's what I thought. Okay. I knew I was looking at a number that didn't make sense. There we go. 386,810. 44,9. I'm gonna fact check my numbers on that because I may have screwed up. I'm gonna write this down here. 17,378 divided by 386 on deliveries. I need to fact check my Q2 number because I may have screwed up, but that was your average selling price here. And now we're gonna do this again one last time here. 19,878 divided by 1, 2, 3, 1, 2, 3. Okay, and then we had how many vehicles? We had 410,831. See, that's not a decline. It's not a quarter over quarter decline. Yeah, I did screw up the number though. 384. See, that's actually pretty good. So this must just be a year over year decline that we're talking about here. So let's try it one more time, but just go year over year. 268, 1, 2, 3, 1, 2, 3. And I'm going to go Q2 2023. And I'm going to go with the total deliveries. Divide out by 466, 140, 45,625. Unless I'm screwing up the numbers here, I've got an increase in the average selling price. But whatever. So I don't know where they're recognizing that. So whatever. I'll spend more time on that. I've been sharing the wrong screen. That's a bummer. There we go. So you've just been able to listen to me. Well, you can watch the sticks. Well, you don't like watching the sticks? There wasn't really anything to see here, I guess, other than these numbers that I've written at the top. So I'm still confused, though. on why my number is so wrong here, 19,878. But maybe I'm messing something up. Divided by 443,956. Oh, yeah, I did screw up. There we go. Okay. Now we've got it. Okay. 44774. There we go. Okay, so now you could see the downward trajectory here on average selling prices. You know, Q3 last year, 45,625, went down to 44,9 in Q1, 44,7 in Q2. So that's where you're seeing some of that reduction, and that's 70 cents there for what it's worth. So we're under $45,000 per vehicle now, something to pay attention to. Okay, let's see what else we have. So decline in deliveries, negative FX, it's nominal. We did get higher reg credits on the profitability, growth in the energy storage. And the margin in energy storage is actually pretty good. So I do like to see that. Total, okay, we know this. How did we do on superchargers? Superchargers and charging stations. This is really nice growth year over year. I think this is very important, especially as you expand the network. But I will say that quarter over quarter growth is bad. Let me see here. Maybe before I say it's bad, let me actually divide it. Yeah, that's really slowed down. I'm down at, on chargers, I'm down at just a 3.5% growth rate, which 3.5 annualizes per quarter, annualizes to just 14%. And I don't actually think that's very good. So I'm going to make a note for that. This is bad. So I don't know what's happening. So that's chargers. What about stations? Maybe 6473 divided by 6249. That was also about 3.58%. So I don't like this, mostly because you're opening the network, right, which creates more congestion, but you're growing at half the pace that you were last year. That's a sign of more congestion coming for Tesla owners. So I don't love that. It could also obviously be could be a temporary hit due to layoffs in supercharger team, SC team. Yeah. No. This is nonsense. This Christian here says if Tesla is selling fewer cars, it makes sense they would not be expanding the charging network. And then in all caps, Kevin. See, here's somebody who's got too much money invested in Tesla. But anyway, the reality is if you're going to expand the network to millions of additional vehicles on the road, you need to be expanding this at a faster pace, not a slower pace, because otherwise the service will decline. So, yeah, you got to look at the whole picture here, the whole kit and caboodle here. So... okay, we continue to add to our vehicle lineup globally. That's fine. New trims. After a sequential decline in production in Q2, we expect a sequential increase in production. Right, so you're going to go back to a potential cash flow hit here. Expect free cash flow hit in Q3. This makes sense. Okay. Refresh Model 3 ramp continued. Cybertruck more than tripled. I mean, that's great. That's fantastic. Also, continue to qualify more trims for the vehicle tax credit. Also very good. Preparation of semi-facility, good. Increased deliveries in markets supplied by China. That's fantastic. We like to see that because this is higher margin. This is very good. I'm going to write that down. Good. Higher margin. Okay. Giga Berlin began producing right-hand vehicle markets. Oh, wow. That's for, like, the United Kingdom. I don't even think about that as a manufacturer. You got to do both sides. Q2, we focus on reducing interventions while improving comfort. It's gotten pretty good. You know, it's not yet to where it could be totally unsupervised, but I will say it's getting very good. So I'm pretty optimistic about that. Autopilot visualization, smaller map, blah, blah, blah. Audible is now available as a native app. Oh, actually, I think that's wonderful. I didn't know that. I actually really like that. So Audible is now available as a native app, and Spotify cues can be synced across vehicles. That's great. And you've already got the YouTube app on there, which I think is wonderful. Produced more than 50% more 4680s in Q1. Yeah, now keep in mind, the 4680s are really only being manufactured right now for the Cybertruck. Pretty much exclusively for Cybertruck. Mostly because regular batteries from China have plummeted in cost. All right, so very well. Energy storage, generation, record revenues. Of course, they did great here. Lathrop Mega Factory continues to ramp successfully, achieving production record. That's fantastic. Powerwall 3 rolled out. Cool. People love the home batteries. Also, very high margin product. So, a big fan of that. That's why I'm also a fan of Enphase. It's those margins. It's very, very good. Let's see here. Then we've got, what do we got here? This is the data center expansion. That looks very nice. Glass facility. That's very cool. This is the Corpus Christi lithium refinery. Cool. Lithium prices have collapsed, so I don't know how much I care about that. Coatings, Quicksilver color, 1.99%. Financing. Here's some gigapacks installed. Oh, yeah, look at that. What did I say? Moving some batteries to a box. That's funny. I joked on this live stream. I'm like, I'm sure Optimus is just moving batteries to a box. Yes, quite literally. That's funny. It's fine. It's fine. I mean, like, it's got to start somewhere. Like, I don't want to poop on it. It looks really good. You know, they put the cladded, 3D printed cladded version on there, so that's cute. Very nice. Okay, you know, free cash flows here. That's fine. These are some reconciliations. Here's our statement of cash flows. Let's see here. So, how about, it looks like our CapEx declined here. This is the lowest CapEx that we've seen in quite a while. So this is the lowest CapEx since Q2 of 2023. So lowest CapEx in 1 year. Okay, interesting. That's with a lot of expansions going on. So it's possible there was some enthusiasm to really have a really good showing here for Q2, right? I mean, Frank, I hate to say it, but there was an incentive to really show a good Q2 here with stock comp on chopping block. Not trying to sound jaded. Just saying it puts more pressure on Q3, Q4 as production and CapEx ramps again. So, you know, something to keep in mind. You know, Q3, Q4 are going to be a little bit of something to watch. Okay, balance sheet. How's our balance sheet doing? We've got about 30 billies in cash. That's pretty delicious. And we've got some prepaids. That's fine. But we do have some bills to pay as well. So, let's see here. Okay. Somebody donated $5. No, sorry. Somebody who's been a member for a month. Oh, that's interesting. See, they're a member. That's very nice. Love your content. This is what it's all about. Keep up the great work. I do wonder about Robotaxi Optimus timelines and its effect on forward PE. How would you price this? Well, unfortunately you can't, right? You can't really price in Robotaxis or Optimus until you actually start producing revenues from it. So, yes, that could substantially lower the impression of today's forward 4-year valuation as you start pricing those things in. Absolutely. But again, you know, that's why you're paying a 3.1 peg right now, or slightly less right now. But that's okay. So what else do we have here? We have total liabilities. Let's add up some of our current liabilities. What do we have here? 9.6 on payables. We've got accrued liabilities of 2.79 plus 2. I'm not going to add the deferred revenue in there. That's fine. Current portion of debt, I'll put 2.2 in. That's actually some pretty good free cash right there. You know, you've got a good chunk of free cash. You've got over 15 billion, almost 16. You have about 16 billion of free cash. 16 billion free cash. No need to raise money anytime soon. Now, where did that cash come from? Did we just take on more debt? From last Q2, we do have about $7 billion more in total liabilities. It looks like our other long-term liabilities, yeah, year over year, $2 billion more in long-term liabilities. So a little bit of a boost there on liabilities. And then if I look at the cash flow statement, it does look like net cash flows from debt. There it is. It does look like we took out about 2.5 in debt to increase some of that cash positioning. So it looks like some of that debt was used to boost available cash. Okay, not too horribly much though. Okay, very well. So good to know here overall on Tesla. I don't think this is actually, I mean, this isn't that bad. I don't think there are really any skeletons in here. Nothing really scary. I think we have the Google earnings call coming up soon, which we could play that as we wait for the Tesla earnings call. Let's find out. So let's see here. Okay. Yeah, 1:30 p.m. Pacific time.
Reporting earnings moments.
No. Okay. Waiting for that to begin. So we'll listen to the Google earnings call again until the Tesla call begins, and then we'll jump over to that one. Yeah, we're still just on hold music right now. Okay, so let me see and confirm when Tesla is going to have their earnings call. It should be at 2, but let's just quickly verify. So let's see what we have here. Oh, 2:30. Oh, okay. You're gonna make us sit here for an hour. Well, we'll be able to get through the whole Google earnings call, I guess.
Over to your speaker today, Jim Friedland, Director of Investor Relations. Please go ahead. Welcome,
Thank
everyone.
You. Good afternoon,
Thank you for
everyone.
standing by.
Thank you.
Nice.
Good afternoon, everyone, and welcome to Alphabet's second quarter 2024 earnings conference call. With us today are Sundar Pichai, Philip Schindler, and Ruth Porat. Now, I'll quickly cover the safe harbor. Some of the statements that we make today regarding our business, operations, and financial performance may be considered forward-looking. Such statements are based on current expectations and assumptions that are subject to a number of risks and uncertainties. Actual results could differ
I'm going to take
materially.
a quick mention here. How the hell did regulatory credits double? Holy smokes. Dude, they really padded Q2, man. Look at this. Q2 just had everything in it. Like, they literally threw the kitchen sink at the second quarter. Automotive regulatory credits, year over year, went from 890 divided by 282, 3x, 3x reg credits year over year. And then we basically, yeah, we doubled quarter on quarter. That's crazy. So it feels like a kitchen sink quarter, but in a good way, right? So you had reg credits, the interest buy downs, capex reduction, stock comp plan, right? Like all of these things happen in this quarter. And the expensive things are coming ahead, I suspect. Anyway, let's get back to the Google call.
AI infrastructure and generative AI solutions for cloud customers have already generated billions in revenues and are being used by more than 2 million developers. As I spoke about last quarter, we are uniquely well positioned for the AI opportunity ahead. Our research and infrastructure leadership means we can pursue an in-house strategy that enables our product teams to move quickly. Combined with our model building expertise, we are in a strong position to control our destiny as the technology continues to evolve. Importantly, we are innovating at every layer of the AI stack, from chips to agents and beyond, a huge strength. We are committed to this leadership long term. This was underscored by the announcements we made at I/O, Cloud Next, and Google Marketing Live, and we'll touch on many of them here. Today, I'll start with search, then move to our AI momentum more generally, followed by cloud, YouTube, and some closing thoughts. Let's dive in. Over the past 25 years, we have continued to reimagine and expand Google Search across many technological shifts. With AI, we are delivering better responses on more types of search queries and introducing new ways to search. We are pleased to see the positive trends from our testing continue as we roll out AI overviews, including increases in search usage and increased user satisfaction with the results. People who are looking for help with complex topics are engaging more and keep coming back for AI overviews. And we see even higher engagement from younger users aged 18 to 24 when they use search with AI overviews. As we have said, we are continuing to prioritize approaches that send traffic to sites across the web. And we are seeing that ads appearing either above or below AI overviews continue to provide valuable options for people to take action and connect with businesses. Beyond AI overviews, AI expands the types of queries we are able to address and opens up powerful new ways to search. Visual search via Lens is one. Soon you'll be able to ask questions by taking a video with Lens. And already we have seen that AI overviews in Lens leads to an increase in overall visual search usage. Another example is Circle to Search, which is available today on more than 100 million Android devices. We are seeing tremendous momentum from our AI investments. More than 1.5 million developers are now using Gemini across our developer tools. And we recently unveiled new models that are more capable and efficient than ever. Gemini now comes in 4 sizes, with each model designed for its own set of use cases. It's a versatile model family that runs efficiently on everything from data centers to devices. At 2 million tokens, we offer the longest context window of any large-scale foundation model to date, which powers developer use cases that no other model can handle. Gemini is making Google's own products better. All 6 of our products with more than 2 billion monthly users now use Gemini. This means that Google is the company that's truly bringing AI to everyone. Gemini is powering incredibly helpful features in Search, Workspace, Google Messages, and more. At I/O, we showed new features coming soon to Gmail and to Google Photos. Soon you'll be able to ask Photos questions like, "What did I eat at that restaurant in Paris last year?" For a glimpse of the future, I hope you saw Project Astra at I/O. It shows multimodal understanding and natural conversational capabilities. We've always wanted to build a universal agent, and it's an early look at how they can be helpful in daily life. Our AI product advances come from our long-standing foundation of research leadership, as well as our global network of infrastructure. In Q2, we announced our first data center and cloud region in Malaysia and expansion projects in Iowa, Virginia, and Ohio. Our TPUs are a key bet here too. Trillium is the 6th generation of our custom AI accelerator, and it's our best performing and most energy efficient TPU to date. It achieves a near 5x increase in peak compute performance per chip and is 67% more energy efficient compared to TPU v5e. And the latest NVIDIA Blackwell platform will be coming to Google Cloud in early 2025. We continue to invest in designing and building robust and efficient infrastructure to support our efforts in AI, given the many opportunities we see ahead. Of course, as we do this, we'll continue to create capacity by allocating resources towards our highest priorities. We are relentlessly driving efficiencies in our AI models. For example, over the past quarter, we have made quality improvements that include doubling the core model size for AI overviews, while at the same time improving latency and keeping cost per AI overview served flat. And we are focused on matching the right model size to the complexity of the query in order to minimize impact on cost and latency. Separately on our real estate investments, we are taking a measured approach to match the current and future needs of our hybrid workforce, as well as our local communities. Next, Google Cloud. We continue to see strong customer interest, winning leading brands like Hitachi, Motorola Mobility, and KPMG. Our deep partnership with Oracle significantly expanded our joint offerings to their large customer base. Our momentum begins with our AI infrastructure, which provides AI startups like Essential AI with leading cost performance for models and high-performance computing applications. We continue to drive fundamental differentiation with new advances since Cloud Next. This includes Trillium, which I mentioned earlier, and A3 Mega powered by NVIDIA H100 GPUs, which doubles the
Yeah, I am also, by the way, also listening to hear if I hear anything about these chip prices coming down. I think that'll be really important. By the way, if you always want my perspective on some of these things, maybe before I even get around to making a video on it, you could hear my perspectives in the course member live streams. Make sure you join. Use that coupon code. Expiring soon. Price will be going up. But course member live stream this morning, we were focused on Amazon, UPS fundamental analysis, and the Tesla earnings preview. We did that all in the course member live. We do those every day the market is open, so I hope you get to join those in the future. Just go to meetkevin.com to learn more.
For a check on soft landing expectation.
Oops.
Cloud provider to offer grounding with Google Search, and we are expanding grounding capabilities with Moody's, MSCI, ZoomInfo, and more. Our AI-powered applications portfolio is helping us win new customers and drive upsell. For example, our conversational AI platform is helping customers like Best Buy and Gordon Food Service. Gemini for Workspace helps Click Therapeutics analyze patient feedback as they build targeted digital treatments. Our AI-powered agents are also helping customers develop better quality software, find insights from their data, and protect their organization against cybersecurity threats using Gemini. Software engineers at Wipro are using Gemini Code Assist to develop, test, and document software faster. And data analysts at Mercado Libre are using BigQuery and Looker to optimize capacity planning and fulfill shipments faster. Cybersecurity risks continue to accelerate, and the number of breaches continue to grow, something we all see in the news every day and that our Mandiant teams help manage. Our strong track record of uptime, quality control, and reliability make Google Cloud the trusted security choice for organizations like Fiserv and Marriott International. In Q2, we infused
the perfect time to pitch their cybersecurity after the whole CrowdStrike stuff.
Helping TELUS strengthen its proactive security posture. Turning next to YouTube. YouTube is focused on a clear strategy, connecting creators with a massive audience and enabling them to build successful businesses through ads and subscriptions while helping advertisers reach their desired audience. We had a great brandcast this quarter, and Philip will say more. I'm pleased with the progress here. YouTube has remained number one in US streaming watch time, according to Nielsen. Views of YouTube Shorts on connected TVs more than doubled last year, and we are making it easier for creators to add captions and turn regular videos into shorts. Next, on Android and Pixel. We joined Samsung for their Galaxy Unpacked event a few weeks ago, and we shared that Samsung's new devices will include the latest AI-powered Google updates on Android. It was a great event. I'm looking forward to our Made by Google event happening in August. We'll have lots to share around Android and the Pixel portfolio of devices. Our Pixel line is doing well. We recently introduced the new Pixel 8a, powered by our latest Google Tensor G3 chip. It provides beautiful AI experiences like Circle to Search, Best Take, and a Gemini-powered AI assistant. In other bets, I'm really pleased with the progress Waymo is making, a real leader in the space and getting rave reviews from users. Waymo has served more than 2 million trips to date and driven more than 20 million fully autonomous miles on public roads. Waymo is now delivering well over 50,000 weekly paid public rides, primarily in San Francisco and Phoenix. And in June, we removed the waitlist in San Francisco so anyone can take a ride. Fully autonomous testing is underway in other Bay Area locations without a human in the driver's seat. Before I close, I want to acknowledge that today is Ruth's final earnings call. Let me take a moment to thank her for all she has done for Google and Alphabet as our longest-serving CFO. I'm excited to continue to work with her in her new role. And I look forward to welcoming our newly appointed CFO, Anat Ashkenazi. She starts next week, and you'll hear from her on our call next quarter. Thanks, as always, to our employees and partners everywhere.
All right, here comes the Q&A for Google, which will be a big deal. And then after we get the Q&A for Google, we'll be gearing up for the Tesla earnings call.
Performance. Google Services delivered revenues of 73%
Oh, never mind. We're going to get the CFO first, or financing first.
year on year. Search and other revenues grew 14% year on year, led by growth in the retail vertical, followed by financial services. YouTube ads revenues were up 13% year on year, driven by growth in brand as well as direct response. Network revenues declined 5% year on year. In subscriptions, platforms, and devices, year-on-year revenues increased 14%, driven again by strong growth in YouTube subscriptions. For the rest of my remarks, I want to double-click on two topics. First, how we are applying AI across the marketing process to deliver an even stronger ads experience. Second, YouTube's position as the leading multi-format platform. So let me start by sharing some of the ways we're applying AI to bring more performance benefits to even more businesses. Q2 brought several major opportunities to meet and learn from users, developers, creators, and customers. From I/O to Brandcast, Google Marketing Live, and Cannes, a growing number of our customers and partners are looking to understand how to successfully incorporate AI into their businesses. This quarter, we announced over 30 new ads, features, and products to help advertisers leverage AI and keep pace with the evolving expectations of customers and users. Across search, PMax, demand gen, and retail, we're applying AI to streamline workflows, enhance creative asset production, and provide more engaging experiences for consumers. Listening to our customers, retailers in particular have welcomed AI-powered features to help scale the depth and breadth of their assets. For example, as part of a new and easier-to-use merchant center, we've expanded Product Studio with tools that bring the power of Google AI to every business owner. You can upload a product image, prompt the AI with something like, feature this product with Paris skyline in the background, and Product Studio will generate campaign-ready assets. I also hear great feedback from our customers on many of our other new AI-powered features. We're beta testing virtual try-on and shopping ads and plan to roll it out widely later this year. Feedback shows this feature gets 60% more high-quality views than other images and a higher click-out to retailer sites. Retailers love it because it drives purchasing decisions and fewer returns. Our AI-driven profit optimization tools have been expanded to Performance Max and standard shopping campaigns. Advertisers who use profit optimization and smart bidding see a 15% uplift in profit on average compared to revenue-only bidding. Lastly, Demand Gen is rolling out to Display and Video 360 and Search Ads 360 in the coming months, with new generative image tools that create stunning, high-quality image assets for social marketers. As we said at GML, when paired with Search or PMax, Demand Gen delivers an average of 14% more conversions. The use cases we're seeing across the industry show the incredible potential of these AI-enabled products to improve performance. Let me briefly share two examples with you. Luxury jewelry retailer Tiffany leveraged Demand Gen during the holiday season and saw a 2.5% brand lift in consideration and actions, such as adding items to carts and booking appointments. The campaign drove a 5.6 times more efficient cost per click compared to social media benchmarks. Our own Google marketing team used Demand Gen to create nearly 4,500 ad variations for a Pixel 8 campaign shown across YouTube, Discover, and Gmail, delivering twice the click-through rate at nearly a quarter of the cost. In addition to strengthening our ads products for customers, we continue to evolve our existing systems and products with improved models, delivering further performance gains. In just 6 months, AI-driven improvements to quality, relevance, and language understanding have improved broad match performance by 10% for advertisers using smart bidding. Also, advertisers who adopt PMax to broad match and smart bidding in their search campaigns see an average increase of over 25% more conversions or value at a similar cost. We'll continue to listen to our customers and use their feedback to drive innovation across our products. As you can hear, I continue to be excited about the AI era for ads. Now let's turn to YouTube. I've talked before about our approach to making YouTube the best place to create, watch, and monetize. First, the best place to create. What sets YouTube apart from every other platform are the creators and the connection they have with their fans. Audiences tuning in to watch their favorite creators continue to grow. For example, 2 weeks ago, Mr. Beast's channel hit more than 300 million subscribers. Next, the best place to watch. Our long-term investment in CTV continues to deliver. Views on CTV have increased more than 130% in the last 3 years. According to Nielsen, YouTube is the #1 most watched streaming platform on TV screens in the US for the 17th consecutive month. Zooming out, when you look not just at streaming, but at all media companies and their combined TV viewership, YouTube is the second most watched after Disney. And this growth is happening in multiple verticals, including sports, which has seen CTV watch time on YouTube grow 30% year over year. Lastly, the best place to monetize. CTV on YouTube is continuing to benefit from a combination of strong watch time growth, viewer and advertiser innovation, and a shift in brand advertising budgets from linear TV to YouTube. Our largest advertisers across verticals, including retail, entertainment, telco, and home and personal care, are partnering with creators on ads and organic integrations. Verizon, for example, worked with a YouTube creator and Verizon customer to show the many ways that plans and offerings can be customized to fit people's lives. Using AI-powered formats, they created sketches in multiple lengths and orientations to serve the right creative to the right viewer and drive people to their site. Verizon's creator ads had a 15% lower CPA and a 38% higher conversion rate versus other ads. Turning to Shorts. Last quarter, I shared that in the US, the monetization rate of YouTube Shorts relative to in-stream viewing is showing a healthy rate of growth. Again, this quarter, we continue to see an improvement in Shorts monetization, particularly in the US. We're also seeing a very encouraging contribution from brand advertising on Shorts, which we launched on the product in Q4 last year. Lastly, a few words on shopping. Last year, viewers watched 30 billion hours of shopping-related videos, and we saw a 25% increase in watch time for videos that help people shop. While it's still early days, shopping remains a key area of investment. At GML, we rolled out several product updates to YouTube Shopping, helping creators sell products to their viewers. These updates included product tagging, where creators can tag products in their videos for viewers to discover and purchase, product collections, and a new affiliate hub, a one-stop shop for creators to find deals and promotional offers from brands and track their affiliate earnings. With that, I'll finish by saying a huge thank you to Googlers everywhere for their extraordinary commitment and to our customers and partners for their continued collaboration and trust. And Ruth, thanks for your amazing leadership and partnership over all these years. Now, for one last time, it's over to you.
Thank you, Philip, and thanks, Sundar, for those kind words. We had another strong quarter, driven in particular by performance in search and cloud, as well as the ongoing efforts to durably re-engineer our cost base. My comments will be on year-over-year comparisons for the second quarter unless I state otherwise. I will start with results at the Alphabet level, followed by segment results, and conclude with our outlook. For the second quarter, our consolidated revenues were $84.7 billion, up 14%, or up 15% in constant currency. Search remained the largest contributor to revenue growth. In terms of expenses, total cost of revenues was $35.5 billion, up 11%. Other cost of revenues was $22.1 billion, up 14%, with the increase driven primarily by content acquisition costs, followed by
Search remained the largest contributor to revenue growth. That's a big deal. That means AI is helping them, not hurting them.
Applied retroactively. Operating expenses were $21.8 billion, up 5%, primarily reflecting an increase in R&D, partially offset by a decline in G&A, with sales and marketing essentially flat to the second quarter last year. The increase in R&D was driven primarily by compensation, which was affected by lapping a reduction in valuation-based compensation liabilities in certain other bets in the second quarter last year, followed by depreciation. The largest single factor in the year-on-year decline in G&A expenses was lower charges related to legal matters. Operating income was $27.4 billion, up 26%, and our operating margin was 32%. Net income was $23.6 billion, and EPS was $1.89. We delivered free cash flow of $13.5 billion in the second quarter and $60.8 billion for the trailing 12 months. As a reminder, last year, we had a timing benefit in the second and third quarters from a $10.5 billion deferred cash tax payment made in the fourth quarter, which depressed reported free cash flow growth this quarter and will do so again next quarter. We ended the quarter with $101 billion in cash and marketable securities. Turning to segment results. Within Google Services, revenues were $73.9 billion, up 12%. Google Search and other advertising revenues of $48.5 billion in the quarter were up 14%, led again by growth in retail, followed by the financial services vertical. YouTube advertising revenues of $8.7 billion were up 13%, driven by brand, followed by direct response advertising. Network advertising revenues of $7.4 billion were down 5%. Subscription platforms and devices revenues were $9.3 billion, up 14%, primarily reflecting growth in YouTube subscription revenues. TAC was $13.4 billion, up 7%. Google Services operating income was $29.7 billion, up 27%, and the operating margin was 40%. Turning to the Google Cloud segment, revenues were $10.3 billion for the quarter, up 29%, reflecting first significant growth in GCP, which was above growth for cloud overall and includes an increasing contribution from AI, and second, strong Google Workspace growth, primarily driven by increases in average revenue per seat. Google Cloud delivered operating income of $1.2 billion and an operating margin of 11%. As to our other bets for the second quarter, revenues were $365 million, and the operating loss was $1.1 billion. Turning to our outlook for the business, with respect to Google Services, first within advertising, the strong performance of search was broad-based across verticals. In YouTube, we are pleased with the growth in the quarter. We had healthy watch time growth, continued to close the monetization gap in Shorts, and had continued momentum in connected TV, with brand benefiting in part from an ongoing shift in budgets from linear television to digital. As we look forward to the third quarter, we will
Good for Trade Desk.
see the increasing strength in advertising revenues in the second half of 2023, in part from APAC-based retailers. Turning to subscriptions, platforms, and devices. First, we continue to have significant growth in our subscriptions business, which drives the majority of revenue growth in this line. However, there was a sequential decline in the year-on-year growth rate as we anniversaried the impact of a price increase for YouTube TV in the second quarter last year. The impact will persist through the balance of the year. Second, with regard to platforms, we are pleased with the performance in Play, driven by an increase in buyers. Finally, with respect to devices, the most important point as we look forward is that our Made by Google launches have been pulled forward into the third quarter from the fourth quarter last year, benefiting revenues in Q3 this year. Turning to cloud, which continued to deliver very strong results. For the first time, cloud crossed $10 billion in quarterly revenues and $1 billion in quarterly operating profit. As Sundar noted, year-to-date, our AI infrastructure and generative AI solutions for cloud customers have already generated billions in revenues and are being used by more than 2 million developers. We're particularly encouraged that the majority of our top 100 customers are already using our generative AI solutions. We continue to invest aggressively in the business. Turning to margins. The margin expansion in Q2 versus last year reflects our ongoing efforts to durably re-engineer our cost base as well as revenue strength. Our leadership team remains focused on our efforts to moderate the pace of expense growth in order to create capacity for the increases in depreciation and expenses associated with the higher levels of investment in our technical infrastructure. Once again, headcount declined quarter on quarter, which reflects both actions we have taken in the first half of the year and a much slower pace of hiring. Looking ahead, we expect a slight increase in headcount in the third quarter as we bring on new graduates. As we have discussed previously, we are continuing to invest in top engineering and technical talent, particularly
that's
in cloud
good.
and
Slight
technical
growth
infrastructure.
is better than slight decline, right? You want to see some hiring, so this is good. Good for the economy. I like this. This is good.
Alphabet operating margin expansion relative to 2023. However, in the third quarter, operating margins will reflect the impact of both the increases in depreciation and expenses associated with the higher levels of investment in our technical infrastructure, as well as the increase in cost of revenues due to the pull forward of hardware launches into Q3. With respect to CapEx, our reported CapEx in the second quarter was $13 billion. Once again, driven overwhelmingly by investment in our technical infrastructure, with the largest component for servers, followed by data centers. Looking ahead, we continue to expect quarterly CapEx throughout the year to be roughly at or above the Q1 CapEx of $12 billion, keeping in mind that the timing of cash payments can cause variability in quarterly reported CapEx. With regard to other bets, we continue to focus on improving overall efficiencies as we invest for long-term returns. Waymo is an important example of this.
No decline yet in CapEx spending. That's also pretty good for the chip manufacturers. I'll hand it to NVIDIA.
You will see in the 10Q, we have chosen to commit to a new multi-year of $5 billion. This new round of funding, which is consistent with recent annual investment levels, will enable Waymo to continue to build the world's leading autonomous driving technology company. To close, this is my 56th and last earnings call, 37 of them at Alphabet, so I have a few closing thoughts of gratitude. I've been so proud to be at Google and Alphabet as CFO and to work with some of the smartest people in the world every day. I think we have accomplished a lot in the last 9+ years, and I am confident that progress will continue. Of course, I'm not going far, and I'm honored to have my new role, which I've been slowly working my way into during the past 11 months, and I look forward to continuing to work with Sundar and our great team. Being CFO of one of the most important companies in the world has been the opportunity and responsibility of a lifetime. Google's mission of advancing technology and bringing information to people throughout the world is as relevant today as it was when I worked on its IPO. Technology has been a catalyst for economic growth throughout human history. The people on this call know that if technological advancement is not the focus of every business and government, they will be left behind. Underpinning this is the need for sound and responsible investment. That has never been more important than today, and certainly that is Google and Alphabet's focus. I want to end by thanking Googlers around the world for the innovation and commitment that has enabled us to deliver such extraordinary products and services globally. I also want to thank our investors and analysts for your long-term support and your feedback. Thank you. Sundar, Philip, and I will now take your questions.
Thank you. As a reminder, to ask a question, you will need to press star 1 on your telephone. To prevent any background noise, we ask that you please mute your line once your question has been stated. Your first question comes from Brian Nowak with Morgan Stanley. Your line is now open.
Thanks for taking my questions. First, thank you, Ruth, for all the help and significant impact over the past decade. The first one, it's a little bit of a jump ball, I guess, for Sundar, Philip, or Ruth. I guess we're sort of 18 months into this fever pitch around a Gen AI focus in the world. Maybe from any of your perspective, can you just sort of talk to us about areas where you've seen faster than expected traction or testing adoption of some of the generative AI capabilities versus slower than expected traction and testing from a Google perspective? And then Ruth, appreciate all the comments about structurally re-engineering the OpEx base. Are there any more tangible examples of areas you can talk to us about where you still see further ways to drive more efficiency across the company? Thanks.
Brian, thanks. I'll take the first part. I think it's a good question. Obviously, I think there is a time curve in terms of taking the underlying technology and translating it into meaningful solutions across the board, both on the consumer and the enterprise side. Definitely on the consumer side, I'm pleased, as I said in my comments earlier, in terms of how, for a product like search, which is used at that scale over many decades, how we've been able to introduce it in a way that it's additive and enhances the overall experience and is positively contributing there. I think across our consumer products, we've been able, I think we are seeing progress on the organic side. Obviously, monetization is something that we would have to earn on top of it. The enterprise side, I think we are at a stage where definitely, there are a lot of models. I think roughly the models are all kind of converging towards a set of base capabilities. But I think where the next wave is, working to build solutions on top of it. And I think there are pockets, be it coding, be it in customer service, etc., where we are seeing some of those use cases, seeing traction. But I still think there is hard work there to completely unlock those.
And on your second question, first, thank you for your comments. Look, the reason we've consistently used the phrase that we're focused on durably re-engineering our cost base is because these are deep work streams. They're not tactical fixes, and we continue to build on them. And so the main areas that we've talked about are around product and process prioritization, around organizational efficiency and structure. Both of those are reflected in the headcount and the fact that headcount is down year on year. And across all of those, as I said, across our entire leadership team, we remain focused on continuing to execute against them. So in terms of, the most recent examples, as we talked about last quarter, with the combination of the devices and services product area with the platforms and ecosystems product area. We announced that back in April. And what we discussed last quarter and what we're seeing is that unifying teams across these organizations helps with product execution. And what we're really focused on is really adding to velocity and efficiency. So kind of the gift that keeps giving. And then more broadly, all of the work streams that we've talked to you about before, we continue to remain focused on. A big one, very important one, is all of the efficiency efforts, the work streams around technical infrastructure and improving efficiency there. We're also working on the use of AI across Alphabet. We're working on continuing to build on what we've done with our centralized procurement organization. We're continuing to optimize our real estate portfolio. And so, again, this is across our leadership team. These are efforts that all build to this phrase, durably re-engineering our cost base.
Great. Thank you both.
And our next question comes from Doug Anmuth with J.P. Morgan. Your line is now open.
Thanks for taking questions. One for Ruth and one for Sundar. Ruth, you've now had Google Services operating margins of roughly 40% for the past 2 quarters. Just as you create more capacity to help offset the future investments, is it reasonable to think that you could sustain at those kind of levels going forward? And then, Sundar, just as it relates to AI overviews, you talked about the positive trends there. Could you just help us understand where you are, how far along in rolling out AI overviews, and then any more color around kind of click-through rates and monetization levels relative to your traditional searches? Thanks.
So in terms of the Google Services operating margin, it did reflect all the work that we're doing on durably re-engineering the cost base. It also reflected the benefit of strong revenue performance in search. And so what I tried to lay out in the comments as we look forward to the third quarter is operating margins it will reflect the increases in depreciation and expenses associated with higher levels of our investment in technical infrastructure. It will also reflect higher expenses associated with the Pixel launch due to the pull forward. So those are important factors. I would say overall, company-wide, it's important to note that we do expect to continue to deliver full year 24 Alphabet operating margin expansion relative to 2023, but did want to highlight those important points as we look forward to Q3.
And Doug, thanks on the AI overviews. We are, we have rolled it out in the U.S. And we are, will be through the course of the year definitely scaling it up, both export to more countries, and also, we have taken a conservative start, focused on quality, making sure the metrics are healthy, and so on. So, but you will see us expand the use cases around it, and we'll touch definitely more queries. All the feedbacks we have seen are positive, and on the monetization side, I think Philip has touched upon it. Maybe Philip, anything more you want to add there?
Yeah, yeah. Look, innovation and improvements to the user experience on search have historically opened up new opportunities for advertisers. We talked about this before. We saw this when we navigated Optimal, for example, and we can see Gen AI obviously expand the types of questions we can help people with, as Sundar mentioned. And as we said before, people are finding ads either above or below AI overviews helpful. We have a solid baseline here from which we can innovate. And as you have probably noticed at GML, we announced that soon we'll actually start testing search and shopping ads in AI overviews for users in the US, and they will have the opportunity to actually appear within the AI overview in a section clearly labeled as sponsored when they're relevant to both the query and the information in the AI overview, really giving us the ability to innovate here and take this to the next level.
It's actually very impressive what they're saying, getting these ads, advertisements built into the Gemini search query when somebody goes to Google and types a question in. It's actually brilliant. Great job.
Go ahead.
Thanks. I have two, one for Sundar, one for Philip. Sundar, on the decision this week to not deprecate cookies, I know it's been a long journey. Can you talk a bit about what we should expect in terms of the new experience in Chrome and why the company made the decision not to go down the path of deprecating cookies? And then, Philip, I know it's only one quarter, but it's interesting that search is growing faster than YouTube, which surprised some of us. So can you talk about what factors you think are behind the differences in growth rates between these markets? And is there anything on the AI front that you could see maybe re-accelerating YouTube growth as you've seen happen with search? Thanks so much.
And Michael, on cookies, look, I think obviously, we are super committed to improving privacy for users in Chrome. And that was the whole focus around privacy sandbox, and we remain committed on the journey. But on third-party cookies, given the implications across the ecosystems and considerations and feedback across so many stakeholders, we now believe user choice is the best path forward there. And we'll both improve privacy by giving users choice, and we'll continue our investments in privacy enhancing technologies. But it's obviously an area we will be taking feedback from the players in the ecosystem, and we are committed to being privacy first as well. Philip?
And on the second part of your question, maybe Ruth, you want to jump in first, and then I take the rest if needed.
Absolutely. So, look, as we both noted, search revenues really reflected broad-based growth across verticals. That was led by retail, followed by financial services. I think your question really goes to the heart of the year-on-year growth comparison. And as both Philip and I noted, we're really pleased with YouTube, the YouTube team, all that was done. Was driven by brand, followed by direct response. And they had very strong ongoing operating metrics, which Philip will comment on. I think the important point to note, I tried to tease out in opening comments, was that the deceleration in this year-on-year revenue growth for the second quarter versus the first quarter primarily reflected the tougher comparison versus the first quarter. Because at that point, as you probably recall, YouTube was lapping negative year-on-year growth in Q1 last year. And then also Q1 benefited from the extra day from leap year. And so what you're also seeing here is with YouTube, we were anniversarying the ramp in APAC-based retailers that began in the second quarter last year, and foreign exchange headwinds as well that we noted. And so there's some timing issues going on, and what we're trying to highlight is the underlying operating strength. Back to you, Philip.
Yeah, that was very comprehensive. Nothing really to add from my side here.
The only thing I would say, I think, to Brian's first question on areas where things are maybe taking longer, I think, look, we are all building multimodal models. At least Gemini has been natively multimodal from the ground up. But most of the use cases today that have been unlocked have been around the tech side. So in terms of getting real generative audio, video experiences working well, I think there is still, it's going to take some time, but over time, obviously, it'll be deeply relevant to YouTube, and so it's an area I'm excited about in the future.
Okay. Thanks, all. And best to you. Thanks.
Your next question comes from Eric Sheridan with Goldman Sachs. Your line is now open.
Thanks so much. And I'll echo the thanks for Ruth for all the insights and partnership over the years on these earnings calls. Sundar, maybe first for you, in terms of cloud and bringing AI to the enterprise, I wanted to know if you go a little bit deeper in terms of how you're seeing AI actually get adopted, implemented, what it potentially could mean for the strategic positioning of the cloud business and the potential for AI workloads to be a stimulant to revenue growth for cloud first. And then following up, the last set of questions on YouTube were really about the macro or the ad environment. What do you guys as a team continue to learn about the subscription side of YouTube and the appetite for consumers to engage with a broader array of media products at the subscription layer? Thanks.
Thanks, Eric. Look, on the cloud and AI stuff, obviously, it's something which I think will end up being a big driver over time. I mentioned in my opening remarks already. If you take a look at our AI infrastructure and generative AI solutions for cloud across everything we do, be it compute on the AI side, the products we have through Vertex AI, Gemini for Workspace, and Gemini for Google Cloud, etc. We definitely are seeing traction. People are deeply engaging with Gemini models across Vertex and AI Studio. We now have over 2 million developers playing around with these things. And you are definitely seeing early use cases. But I think we are in this phase where we have to deeply work and make sure on these use cases, on these workflows, we are driving deeper progress and unlocking value, which I'm very bullish will happen. But these things take time. So, but if I were to take a longer term outlook, I definitely see a big opportunity here. And I think particularly for us, given the extent to which we are investing in AI, our research infrastructure, leadership, all of that translates directly. And so, I'm pretty excited about the opportunity space ahead.
And then on your second question with respect to subscriptions, kind of implicit in your question, how strong is it? As I noted in opening comments, that overall line, subscriptions, platforms, and devices delivered healthy growth, and that was led by subscriptions. And as we've said on many calls here in a row, the subscription.
If you want a summary so far, just go to ehack.com. It should be up there, but I've been summarizing it. I kind of, as these things are going, I just type the summaries up on ehack.com. So should see Google, Enphase, and Tesla summaries on there.
Subscriber and revenue growth, but I think the heart of your question is really around YouTube, and that is the heart of the revenues in that line. So it continues to be very strong. We see a lot of take up in it, strong subscriber growth, really pleased with it. We did note that growth on that line decelerated due to anniversarying this YouTube TV price increase, but at the heart of it are people interested in the subscription offerings, and as the take up significant, we're really pleased with it.
Thank you.
Our next question comes from Ross Sandler with Barclays. Your line is now open.
Hi, everybody. Just two questions.
Tesla earnings call is in 13 minutes. I'll cover that, obviously.
So it looks like, from the outside at least, that the hyperscaler industry is going from kind of an underbuilt situation this time last year to better meeting the demand with capacity right now to potentially being overbuilt next year if these CapEx growth rates keep up. So do you think that's a fair characterization, and how are we thinking about the return on invested capital with this AI CapEx cycle? And then related to that, do you think that the AI industry is close to or far away from hitting some kind of wall on foundation model improvement in AI training based on like lack of availability of new data to train on. Just your thoughts on that would be great. Thank you.
Thanks, Rob.
Oops. Yeah, that's actually really interesting. I want to hear that this talk about new data. Like, what if you run out of the data to train on? Like, how are you going to keep advancing AI, right?
Transformative area, and in technology, when you're going through these transitions, aggressively investing upfront in a defining category, particularly in an area in which, in a leveraged way, cuts across all our core areas, our products, including search, YouTube, and other services, as well as fuels growth in cloud and supports the innovative long-term bets and other bets. Is definitely something for us makes sense to lean in. I think the one way I think about it is when you go through a curve like this, the risk of underinvesting is dramatically greater than the risk of overinvesting for us here, even in scenarios where, if it turns out that we are overinvesting, these are infrastructure which are widely useful for us. They have long, useful lives, and we can apply it across, and we can work through that. But I think, not investing to be at the frontier, I think, definitely has a much more significant downsides. Having said that, we obsess around every dollar we put in. Our teams work super hard, and I'm proud of the efficiency work, be it optimization of hardware, software, model deployment across our fleet. All of that is something we spend a lot of time on, and that's how we think about it. To your second question, on whether how do the scaling laws hold? Are we hitting on some kind of wall or something? Look, I think we are all pushing very hard, and there's going to be a few efforts which will scale up on the compute side and push the boundaries of these models. What I would tell is, regardless of how that plays out, I still think there is enough optimizations we are all doing, which is driving constant progress in terms of the capabilities of the models. And more importantly, taking them and translating into real use cases across the consumer and enterprise side. I think on that frontier, I think there's still a lot of progress to be had. And so, we are pretty focused on that as well.
Thank you.
Our next question comes from Stephen Ju with UBS. Your line is now open.
Okay, thank you so much. So, Sundar, I guess to ask the AI question a different way, as we talk to some of the model builders out there, it looks like the initial use cases are more on the cost savings or efficiency side. But when do you think we'll start thinking about products that can help revenue generation for the Fortune 500?
That's the big question here. So far, they kind of keep kicking that question down the road. It's like, when are you going to make money from AI?
Hopefully create greater value over time versus just cutting costs. And Philip, listening to what will be, I guess, Ruth's final comments on YouTube on these public calls, and thank you, by the way, Ruth, for all the help. I couldn't help but notice that the bigger factors were brand followed by direct response. And if we continue to think that the one you bring up first is the larger factor, and tying this into your prior commentary about shopping being an important consideration, like, when do you think we'll start talking about direct response being a much bigger contributor to YouTube's growth versus brand? Thank you.
On the first part of the question, look, I think, the technology is horizontal enough. It can apply on both sides. If you take a use case like improving the customer service experience, there's a part of it which is driving efficiencies, and you can look at it from a cost standpoint. But you could also be overall improving the experience, improving conversion, driving the funnel better, and so increasing basket size if you're a retail e-commerce player, etc. So we are seeing people experiment across both sides, and and so I think you will see it play out across both sides. Philip, on the second one.
Yes, on the second one, look, on the direct response side, as you know, it's about driving and converting commercial intent. And customers are obviously benefiting from including video in their AI-powered campaigns. Could be PMax, could be demand gen, and obviously using our automated tools to enhance and create video creatives. And we're very, very optimistic about this path. On average, advertisers who run both image and video ads with demand gen campaigns see 6% more conversions per dollar than those running image-only ads in discovery. And this is just one little example of how this can obviously boost your performance business. So that's a big part. The brand side, as you know, Google AI continues to make it easier for brands to show up next to the content where viewers are obviously the most engaged. And they're finding it, as you can see from the numbers, a very effective way to drive awareness and consideration. And we're also quite excited about some of the recent launches on the YouTube shopping side, if you want to put that into the direct response bucket.
Okay, thank you.
And our last question comes from Justin Post with Bank of America. Your line is now open.
Right on time to get to the Tesla call.
I'd like to ask a couple areas. First, on the cloud acceleration, would you characterize that as new AI demand helping drive that year to date, or is that more of a rebound in just general compute and other demand, or is AI really moving this forward and helping drive acceleration? And then I wanted to ask about your internal cost savings, which has been really strong. How are you using AI internally to help cut costs? Are you seeing better efficiencies with your engineers? And just would love to hear about how you're applying AI to cut your own costs. Thank you.
Great, thank you for that. So overall, we're, as both Sundar and I said, we're very pleased with the results in cloud. And there is clearly a benefit as the cloud team is engaging broadly with customers around the globe with AI-related solutions, AI infrastructure solutions, and the generative AI solutions. You know, I think we noted that we're particularly encouraged that the majority of our top 100 customers are already using our generative AI solution. So it is clearly adding to the strength of the business on top of all that they're doing. And just to be really clear, the results for GCP, the growth rate for GCP is above the growth for cloud overall. And then I'll turn it to Sundar on the cost saving point, but just one point, you know, we're really pleased as well that cloud's margin improved as it did, and in part that reflects the revenue strength that they delivered and all of the efficiency efforts that I've already spoken about. But looking ahead in Q3, we do expect the same seasonal pattern that you saw last year with respect to margin, and we are continuing to invest in the business.
Look, I think specifically, you know, if the question is about engineers and coding, et cetera, you know, we definitely want to be on the cutting edge there. I think we are making these tools available to some of the most productive engineers and demanding engineers out there, and they are definitely kicking the tires hard. But I would say it's still all in very early stages. I think particularly when it comes to writing high quality, secure code. But I think all the learnings, what we are gaining here will translate into our models and products. And that's the virtuous cycle, which I'm excited by. So there's a lot more to come.
Great, thank you.
Thank you, and that concludes our question and answer session for today. I'd like to turn the conference back over to Jim Friedland for any further remarks.
Thanks, everyone, for joining us today. We look forward to speaking with you again on our third.
Okay, so Tesla's about 5-ish minutes away, so we'll get to deal with Tesla in just a bit. So overall, I mean, we'll do a summary of all this stuff later, of course. But yeah, I mean, none of these. This was actually, I think, pretty decent. I actually really kind of enjoyed the call. I thought overall, it's really just exactly what I would expect a company to do with artificial intelligence, which is, you know, make sure we get less or lower our expenses, and then not only lower our expenses, but also create a better quality product for the customer. And that's really all I think AI should really be expected to do. You're increasing quality, and so I do think there is a lot of an expectation that AI is going to be this giant boom of new revenue. I've never been convinced by that. and so far it's been true. We haven't really seen it, but who knows? Maybe it'll pop up from out of nowhere. I don't know, but I find it very interesting, and we'll watch how the market prices all of this in. So far, it looks like the market said no thanks to Google there to some extent, given that you're down about 1.9% on Google after hours. I think that's really because people were looking for some more revenue drivers from Google from AI, and you didn't really get those. Again, not a horrible surprise to me. Now, as far as the Tesla call coming up, I think the big things that we're going to be looking for here are going to be what is, where are we on annual deliveries? The near-term numbers are going to matter most to Wall Street. So, how negative are we going to go year over year? We're expecting 1.8 to the downside, 1.8 million vehicles, expecting that to be nominally negative versus last year. It'd be nice to hear some progress on robotaxi and also some more details around what is this? Like, is it just one prototype vehicle? Is this limited to a specific city? Is this kind of going to be like Waymo in Arizona where it's 10 years of practicing? Some insight and color on that would be interesting. I'm sure questions will come up on that. I'm not convinced that Elon will be willing to provide many answers on it. But I do think that there will be a lot of questions about it. There might be some questions giving us a little bit of clarity on what to expect for these interest rate buy downs and how those are affecting the average selling price. Obviously, we've seen the average selling prices fall, and I don't know that Elon's going to give us anything super euphoric because I think a lot of the euphoria was already here in Q2, and then we kind of killed that momentum a little bit when the robotaxi event got delayed, which is unfortunate. And I also think there's some, I don't think you'll see this come up, but there's in what's it called in the earnings call, but I do think there's also some risk to Elon donating so publicly to Donald Trump. I don't think, or to this PAC. I get it. I see what he's doing. It's not in the good graces of the what's it called, Biden administration. So he's pushing for whatever he can pull off over at hopefully, in his opinion, his hopeful and new Trump administration to help out Tesla. Although regulatory credits, in fairness, did just triple year over year and they doubled quarter over quarter. So, but the problem is you might alienate, the Never Trump audience. I don't know though that you're going to alienate the Never Trump audience any more than you already have, but it's possible. So, whatever. I don't actually think there'll be any comments on that. But that is something that some folks do share some concerns over. So I don't see that it just started yet. I'm here. Let me see. Has it?
Raise hand button to join the question queue.
Oh yeah. Thank you.
Before we jump into Q&A.
Their Twitter stream actually started a lot later than their YouTube stream this time.
So to recap, we saw large adoption acceleration in EVs, and then a bit of a hangover as others struggled to make compelling EVs. So there have been quite a few competing electric vehicles that have entered the market, and mostly they have not done well, but they have discounted their EVs very substantially, which has made it a bit more difficult for Tesla. We don't see this as a long-term issue, but really as fairly short-term. And we still obviously firmly believe that EVs are best for customers and that the world is headed for a fully electrified transport, not just of cars, but also of aircraft and boats. Despite many challenges, the Tesla team did a great job executing, and we did achieve record quarterly revenues. Energy storage deployments reached an all-time high in Q2, leading to record profits for the energy business. And we're investing in many future projects, including AI training and inference, and a great deal of infrastructure to support future products. we won't get too much into the product roadmap here because that is reserved for product announcement events.
Of course.
But we are on track
to
deliver a more affordable model in the first half of next year. Really, by far, the biggest differentiator for Tesla is autonomy. And in addition to that, we have scale economies, and I think we're the most efficient electric vehicle producer in the world. So, anyway. While others are pursuing different parts of the AI robotics stack, we are pursuing all of them. This allows for better cost control, more scale, quicker time to market, and a superior product, applying not just to autonomous vehicles, but to autonomous humanoid robots like Optimus. Regarding full self-driving and robotaxi, we've made a lot of progress with full self-driving in Q2, and with version 12.5 beginning rollout, we think customers will experience a step change improvement in how well supervised full self-driving works. Version 12.5 has 5 times the parameters of 12.4 and will finally merge the highway and city stacks. So the highway stack is still, at this point, is pretty old. So often the issues people encounter are on the highway, but with 12.5, we finally merged the 2 stacks. I still find that most people actually don't know how good the system is. And I would encourage anyone to understand the system better to simply try it out and let the car drive you around. One of the things we're going to be doing just to make sure people actually understand the capabilities of the car is when delivering a new car and when picking up a car for service, to just show people how to use it and just drive them around the block. Once people use it at all, they tend to continue using it. So it's very compelling, and this, I think, will be a massive demand driver. Even unsupervised full self-driving will be a massive demand driver. And as we increase the miles between intervention, it will transition from supervised full self-driving to unsupervised full self-driving, and we can unlock massive potential in the fleet. We postponed the sort of robotaxi, or the sort of product unveil by a couple months, where it's shifted to 10/10, so the 10th of October. And this is because I wanted to make some important changes that I think would improve the vehicle, the sort of the robotaxi, the main thing that we're going to show, and we're also going to show off a couple of other things. So moving it back a few months allowed us to improve the robotaxi, as well as add in a couple other things for the product unveil. We're also nearing completion of the south expansion of Giga Texas, which will house our largest training cluster to date. This will be an incremental 50,000 H100s plus 20,000 of our hardware 4 or AI5 Tesla AI computer. With Optimus, Optimus is already performing tasks in our factory, and we expect to have Optimus production version 1 in limited production starting early next year. This will be for Tesla consumption. It's just better for us to iron out the issues ourselves. But we expect to have several thousand Optimus robots produced and doing useful things by the end of next year in the Tesla factories. And then in 2026, ramping up production quite a bit. And at that point, we'll be providing Optimus robots to outside customers. That'll be production version 2 of Optimus. For the energy business, this is growing faster than anything else. we are really demand constrained rather than production constrained. So we're ramping up production in our US factory, as well as building the Megapack factory in China that should roughly double our output. Maybe more than double, maybe triple potentially. So in conclusion, we're super excited about the progress across the board. We're changing the energy system, how people move around, how people approach the economy. The undertaking is massive, but I think the future is incredibly bright. I really just can't emphasize just the importance of autonomy for the vehicle side and for Optimus. Although the numbers sound crazy, I think Tesla producing at volume with unsupervised FSD, essentially enabling the fleet to operate like a giant autonomous fleet, and it takes the valuation, I think, to some pretty crazy number. ARK Invest thinks on the order of $5 trillion. I think they're probably not wrong. And long-term Optimus, I think, achieves a valuation several times that number. I want to thank the Tesla team for strong execution and looking forward to exciting years ahead.
Great. Thank you very much, Elon. And Vaibhav has opening remarks as well.
Thanks. As Elon mentioned, the Tesla team rose to the occasion yet again and delivered on all fronts with some notable records. In addition to those records, we saw our automotive deliveries grow sequentially. I would like to thank the entire Tesla team for their efforts in delivering a great quarter. On the auto business front, affordability remains a top of mind for customers, and in response, in Q2, we offered attractive financing options to offset sustained high interest rates. These programs had an impact on revenue per unit in the quarter. These impacts will persist into Q3 as we have already launched similar programs. We're now offering extremely competitive financing rates in most parts of the world. This is the best time to buy a Tesla. I mean, if you're waiting on the sidelines, come out and get your car. We had a record quarter on regulatory credits revenues and as well. On net, our auto margins remained flat sequentially. It is important to note that the demand for regulatory credits is dependent on other OEMs' plans for the kind of vehicles they're manufacturing and selling, as well as changes in regulations. We pride ourselves to be the company with the most American-made cars and are continuing our journey to further localize our supply chain, not just in the US, but in Europe and China, as well for the respective factories. As always, our focus is on providing the most compelling products at a reasonable price. We have stepped up our efforts to provide more trims that have estimated range of more than 300 miles on a single charge. We believe this, along with the expansion of our supercharging network, is the right strategy to combat range anxiety. Since the revision of FSD pricing in North America, we've seen adoption rates increase meaningfully and expect this to be a driver of vehicle sales as the feature set improves further. Cost per vehicle declined sequentially when we removed the impact of Cybertruck. While we are experiencing material costs trending down, note that there is latency on the cost side, and such reductions would show up in the P&L when the vehicles built with these materials get delivered. Additionally, as we get into the second half of the year, it is important to note that we are still ramping Cybertruck and Model 3 and are also getting impacted by varying amounts of tariffs on both raw materials and finished goods. While our teams are working feverishly to offset these, unfortunately, it may have an impact on the cost in the near term. We previously talked about the potential of the energy business and now feel excited that the foundation that was laid over time is bearing the expected results. Energy storage deployments more than doubled, with contribution not just from Megapack, but also Powerwall, resulting in record revenues and profits for the energy business. An energy storage backlog is strong. As discussed before, deployments is dependent on a of factors, including logistics timing, as we send units from a single factory to markets across the world, customer readiness, and in case of EPC projects on construction activities. Moving on to the other parts of the business, service and other gross profits also improved sequentially from the improvement in service utilization and growth in our collision repair business. The impact of our recent reorg is reflected in restructuring and other on the income statement. Just to level set, this was about $622 million of charge, which got recorded in the period. And I want people to remember that we've called it out separately on the financials. Sequentially, our operating expenses, excluding such charges, reduced despite an increase in spend for AI-related activities and higher legal and other costs. On the CapEx front, while we saw a sequential decline in Q2, we still expect the year to be over $10 billion in CapEx as we increase our spend to bring a 50K GPU cluster online. This new cluster will immensely increase our capabilities to scale FSD and other AI initiatives. We reverted to positive free cash flow of $1.3 billion in Q2. This was despite restructuring payments being made in the quarter, and we ended the quarter with over $30 billion of cash and investments. Once again, we've begun the journey towards the next phase for the company, with the building blocks being placed. It will take some time, but will be a rewarding experience for everyone involved. Once again, I would like to thank the entire Tesla team for their efforts.
Great. Thank you very much, Vaibhav. Now let's go to investor questions. The first question is, what is the status on the Roadster?
With respect to the Roadster, we've completed most of the engineering, and I think there's still some upgrades we want to make to it, but we expect to be in production with the Roadster next year.
Great.
It'll be something special, like a Hall of Famer, I think.
Fantastic. The next question is about timing of Robotaxi event, which we've already covered. So we'll go to the next question. When do you expect the first Robotaxi ride?
I guess that's really just a question of when do I expect the first, when can we do unsupervised full self-driving? It's difficult, obviously, my predictions on this have been overly optimistic in the past. So, I mean, based on the current trend, it seems as though we should get miles between interventions to be high enough that it should be far enough in excess of humans that you could do unsupervised possibly by the end of this year. I would be shocked if we cannot do it next year. So next year seems highly probable to me based on simply plus the points of the curve of miles between intervention. That trend exceeds humans for sure next year. So, yeah.
Thank you very much. Our third question is, the Cybertruck is an iconic product that wows everyone who sees it. Do you have plans to expand the cyber vehicle lineup to a cyber SUV or cyber van?
I think we want to limit product announcements to when we have a specific product announcement event rather than earnings calls.
Great, thank you. Our next question is, what is the current status of 4680 battery cell production and how is the ramp up progressing?
Yeah. 4680 production ramped strongly in Q2, delivering 51% more cells than Q1, while reducing COGS significantly. We currently produce more than 1,400 Cybertrucks of 4680 cells per week, and we'll continue to ramp output as we drive costs down further towards the cost parity target we set for the end of the year. We've built our first validation Cybertruck with dry cathode process made on our mass production equipment, which is a huge technical milestone, and we're super proud of that. We're on track for production launch with dry cathode in Q4. And this will enable cell costs to be significantly below available alternatives, which was the original goal of the 4680 program.
Great.
Thank you very much. The next question is, any update on Dojo?
Yeah, so Dojo, I should preface this by saying incredibly impressed by NVIDIA's execution and the capability of their hardware. And what we are seeing is that the demand for NVIDIA hardware is so high that it's often difficult to get the GPUs. There just seems this, I guess I'm quite concerned about actually being able to get state-of-the-art NVIDIA GPUs when we want them. I think this therefore requires that we put a lot more effort on Dojo in order to ensure that we've got the training capability that we need. So we are going to double down on Dojo, and we do see a path to being competitive with NVIDIA with Dojo. And I think we kind of have no choice because the demand for NVIDIA is so high, and it's obviously their obligation essentially to raise the price of GPUs to whatever the market will bear, which is very high. So I think we've really got to make Dojo work, and we will.
Great. The next question is, what type of accessories will be offered with Optimus?
Optimus is intended to be a generalized humanoid robot with a lot of intelligence. So it's like saying what kind of accessories will be offered with a human. It's just really intended to be able to be backwards compatible with human tasks. So it would, use any accessories that a human would use. Yeah.
Thank you. The next question is, do you feel you're cheating people out of the joys of owning a Tesla by not advertising?
We are doing some advertising.
These questions are stupid so far.
Yeah, I'll say something. Our fundamental belief is that we need to be providing the best products at a reasonable price to the consumers. Just to give you a fact, in US alone in Q2, over 2/3 of our sales deliveries were to people who had never owned a Tesla before, and which is encouraging. We've spent money on advertising and other awareness programs, and we have adjusted our strategy. We're not saying no to advertising, but this is a dynamic play, and we know that we have not exhausted all our options, and therefore plan to keep adjusting in the later half of this year as well.
Great, thank you very much. The next question is on energy growth, which we already covered in opening remarks. So we'll move on to the next one. What is the updated timeline for Giga Mexico, and what will be the primary vehicles produced initially?
Well, we currently are paused on Giga Mexico. I think we need to see just where things stand after the election. Trump has said that he will put heavy tariffs on vehicles produced in Mexico. So it doesn't make sense to invest a lot in Mexico if that is going to be the case. So we kind of need to see where things play out politically. However, we are increasing capacity at our existing factories quite significantly. And I should say that the cyber taxi or robotaxi will be produced here at our headquarters at Giga, Texas.
All right, thank you.
Sorry, as will Optimus towards the end of next year for Optimus production version 2. The high volume version of Optimus will also be produced here in Texas.
Great, thank you. Just a couple more. Is Tesla still in talks with an OEM to license FSD?
There are a few major OEMs that have expressed interest in licensing Tesla Full Self-Driving, and I suspect there will be more over time, but we can't comment on the details of those discussions.
All right, thank you. And the last one, any updates on investing in XAI and integrating Grok into Tesla software?
Well, I should say that Tesla is learning quite a bit from XAI. It's been actually helpful in advancing Full Self-Driving and in building up the new Tesla data center. regarding investing in XAI, I think we'd need to have a shareholder approval of any such investment. But I'm certainly supportive of that if shareholders are. But I think we need a vote on that. And I think that there are opportunities to integrate Grok into Tesla software. Yes.
All right. Thank you very much. And now we will move on to analyst questions. The first question comes from Will Stein from Truist. Will, please go ahead and unmute yourself.
Great. Thanks so much for taking my question. And this relates a little bit to the last one that was asked. Elon, I share your strong enthusiasm about AI, and I recognize Tesla's opportunity to do some great things with the technology. But there are some concerns I have about Tesla's commercialization, and that's what I'd like to ask about. Specifically, there were some news stories through the quarter that indicated that you redirected some AI compute systems that were destined for Tesla instead to XAI, or perhaps it was to X, I'm not sure. And similarly, a few quarters ago, if you recall, I asked about your ability to hire engineers in this area, and you noted that there was a great desire for some of these engineers to work on projects that you were involved with, but some of them weren't at Tesla. They were instead at XAI, or perhaps even X again. So the question is, when it comes to your capital investments, your AI R&D, your AI engineers, how do you make allocation decisions among these various ventures, and how do you make Tesla owners comfortable that you're doing it in a way that really benefits them? Thank you.
Yeah, I mean, I think you're referring to a very like an old article regarding GPUs. I think that's like six or 7 months old. Tesla simply had no place to turn them on. So it would have been a waste of Tesla capital, because we would just have to order H100s and have no place to turn them on. So it was just, this wasn't a, let's pick XAI over Tesla. There was no, the Tesla data centers were full. There was no place to actually put them. We've been working 24/7 to complete the south extension on the Tesla Gigafactory here in Texas. That south extension is what will house the 50,000 H100s, and we're beginning to move the H100 server racks into place there. But we needed that to be complete physically. You can't just order GPUs and turn them on with no. You need a data center. It's not possible. So I want to be clear, that was in Tesla's interest, not contrary to Tesla's interest. Does Tesla no good to have GPUs that it can't turn on? The split second that south extension is able to take GPUs, which is really just this week. We are moving GPUs in there, and we'll bring them online. There are people that only want AI. So what I was finding was that when trying to recruit people to Tesla, they were only interested in working on API, not Tesla specific problems, and they wanted to do a startup. So it was a case of either they go to a startup, or and I'm involved, or they do a startup and I'm not involved. Those are the two choices. This wasn't they would come to Tesla. They were not going to come to Tesla under any circumstances. Yeah.
Yeah, I mean, I would even add that, AI is a broad spectrum, and there are a lot of things which, we are focused on full self-driving as Tesla and also Optimus. But there's the other spectrum of AI which we're not working on, and that's the kind of work which other companies are trying to do, in this case, XAI. So you have to keep that in in mind that it's a broad spectrum. It's not just one specific thing.
Yeah, and once again, I want to just repeat myself here. I tried to recruit them to Tesla, including to say, like, you can work on AGI if you want, and they refused. Only then was XAI created.
I really appreciate that clarification. If I can ask one follow-up, it relates to the new vehicles that you're planning to introduce next year. I understand this is not the venue for product announcements, but when we think about the focus, I've heard on the one hand that the focus is on cost reduction. On the other hand, you also said that the Roadster would come out. Should we expect other, maybe more limited variants, like similar to the cars that you make today, but with some changes or improvements or different, some other variability in the form factors? Should we expect that to be a significant part of the strategy in the next year or two?
I don't want to get into the details of product announcements, and we have to be careful of the Osborne effect here. So, if you start announcing some great thing, it affects our near-term sales. We're going to make great products in the future, just like we have in the past. End of story.
Great. The next question comes from Ben Kallo from Baird. Ben, please go ahead and unmute yourself.
Hi, thanks for taking my question. When we think about revenue contribution and with energy growing so quickly and, Optimus on the come, how do we think about, the overall segments longer term? And then do you think that auto revenue will fall below 50% of your overall revenue? And then my follow-up is just on the last call, you talked about distributed compute on your new hardware. Could you just update us and talk a little bit more about that, the timeline for it, and how you would reward customers for letting you use their compute power in their cars? Thanks.
Yeah, I mean, as I've said a few times, I think the long-term value of Optimus will exceed that of everything else at Tesla combined. So it's simply, if you just simply consider the usefulness, utility of a humanoid robot that can do pretty much anything you ask of it, I think everyone on Earth is going to want one. There's 8 billion people on Earth, so that's 8 billion right there. Then you've got all of the industrial uses, which is probably at least as much, if not way more. So I suspect that the long-term demand for general-purpose humanoid robots is in excess of 20 billion units. And Tesla has the most advanced humanoid robot in the world, and is also very good at manufacturing, which these other companies are not. And we've got a lot of experience the most experience. We're the world leaders in real-world AI. So we have all of the ingredients. I think we're unique in having all of the ingredients necessary for large-scale, high-utility, generalized humanoid robots. But that's why, my rough estimate long-term is in accordance with the ARK Invest analysis of, a market cap of on the order of $5 trillion for, maybe more for autonomous transport. And it's several times that number for general-purpose humanoid robots. At that point, I'm not sure what money even means. But in the benign AI scenario, we're headed for an age of abundance, where there is no shortage of goods and services. Anyone can have pretty much anything they want. It's a very wild future we're headed for.
And on the distributed compute?
Yeah, distributed compute. That seems like a pretty obvious thing to do. I think where the distributed compute becomes interesting is with our next generation Tesla AI chip, which is Hardware 5, or what we're calling AI 5, which is from the standpoint of inference capability comparable to a B200, an NVIDIA B200. And we're aiming to have that in production at the end of next year and scale production in 26. So it just seems like even if you've got autonomous vehicles that are operating for 50 or 60 hours a week, there's 168 hours in a week. So you have somewhere above, I think, 100 neural net computing. I think we need a better word than GPU, because GPU means graphics processing unit. So there's 100 hours plus per week of AI inference compute from the fleet, from the vehicles, and probably some percentage from the humanoid robots, that it would make sense to do distributed inference. And if there's a fleet of, at some point, 100 million vehicles with AI 5 and beyond, because you have AI 6 and 7 and whatnot, and there may be billions of humanoid robots, that is just a staggering amount of inference compute that could be used for general purpose computing. It doesn't have to be used for the humanoid robot or for the car. So I think that's a pretty obvious thing to say, like, well, it's more useful than having to do nothing.
All right, thank you. The next question comes from Alex Potter from Piper. Alex, please go ahead and unmute yourself.
Perfect, thanks. Wanted to ask a question on FSD licensing. You mentioned that in passing previously. Was just wondering if you can elaborate maybe on the mechanics of how that would work. I guess presumably this would not be some sort of simple plug and play proposition. Presumably an OEM would need, I don't know, several years to develop its own vehicle platform that's based on FSD. I imagine they would need to adopt Tesla's electrical architecture, compute, sensor stack. So correct me if I'm sort of misunderstanding this, but if you had a cooperative agreement of some kind with another OEM, then presumably it would take you several years before you'd be able to recognize licensing revenue from that agreement. Is that the right way to think about that?
Yes. The OEMs do not move fast. There's not really a sensor suite. It's just cameras. But they would have to integrate our AI computer and have cameras with a 360-degree view. And at least the gateway, like what talks to the internet and communicates with the Tesla system, that you need kind of a gateway computer too. So it's really a gateway computer with cellular and Wi-Fi connectivity, the Tesla AI computer, and 7 cameras, or enough cameras to get a 360-degree view. But this will, given the speed at which the auto industry moves, it would be several years before you would see this in volume.
Okay, good. That's more or less what I expected. So then the follow-up here is, if you did sign an FSD licensing agreement with another automaker, when do you think you would disclose that? Would you do it right when you sign the agreement, or only after that multiple years has passed and the vehicle is ready to be rolled out?
I think it depends on the OEM. I guess we'd be happy either way.
Yeah, it depends on what kind of arrangement we enter into. A lot of those things we've not ironed those out yet. So we'll make that determination as and when we get to that point.
Okay. And the kind of deals that are obviously relevant are only if, some OEM is willing to do this in 1 million cars a year or something significant. It's not if it's like 10,000 or 100,000 cars a year. We could just make that ourselves.
All right, thank you. The next question comes from Dan Levi from Barclays. Dan, please go ahead and unmute yourself.
Hi, good evening. Thanks for taking the questions. First, wanted to start with a question on Shanghai. You've leveraged Shanghai as an export center, really due to its low cost, and that makes sense. But maybe you can just give us a sense of how the strategy changes, if at all, given the implementation of tariffs in Europe? Also, to what extent your import of batteries from China into the US, how that might change given the tariffs? Thank you.
Yeah, I think I covered some part of it in my opening remarks, but just to give you a little bit more, just on the tariff side, the European authorities did sample certain other OEMs in the first round to establish the tariffs for cars being imported from China into Europe. While we were not picked up in our individual examination in the first round, they did pick us up in the second round. They visited our factory, we worked with them, provided them all the information. As a result, we are adjusting our import strategy out of China into Europe. One other thing to note is in Q2 itself, we started building right-hand Model Ys out of Berlin, and we also delivered it in the UK. And, we're adjusting as needed, but, we will keep adjusting. We're still importing Model 3s into Europe out of Shanghai. And, we are still evaluating what is the best alternate to manage all this. Just on the examination by the European authorities, like I said, we cooperated with them well. We are confident that we should get a better rate than what they have imposed for now. But this is literally evolving, and we are adjusting as fast as we can with this. I would also add that, because of this, you've seen the impact that Berlin is doing more imports into places like Taiwan, as well as, UK I just mentioned. So it will keep changing, and we will keep adapting as we go about it.
Great, thanks. Yeah, thank you. As a follow-up, I wanted to ask about the robotaxi strategy, and specifically the shareholder deck here notes that the release is going to be one of the gating factors is regulatory approval. So maybe you could help us understand, which regulations specifically are the ones that we should be looking for. Is it FMVSS that's standard? And then, to what extent does the strategy shift? You've done with FSD more of a nationwide, no boundary approach. Is the robotaxi approach one that's more geofenced, so to speak, and is more driven by a state-by-state approach?
I mean, our solution is a generalized solution, like what everybody else has. If you see it like Waymo and whatnot, they have a very localized solution that requires high density mapping. It's quite fragile. So, their ability to expand rapidly is limited. Solution that would even work on a different Earth. So if you build a new Earth, it would work on a new Earth. So there's capability. I think in our experience, once we demonstrate that something is safe enough or significantly safer than human, we find that regulators are supportive of deployment of that capability. It's difficult to argue with if you've got a large number of, if you've got billions of miles that show that in the future unsupervised FSD is safer than human. What regulator could really stand in the way of that? They're morally obligated to approve. So I don't think regulatory approval will be a limiting factor. I should also say that the self-driving capabilities that are deployed outside of North America are far behind that in North America. So with version 12.5 and maybe 12.6, but pretty soon we will ask for regulatory approval of the Tesla supervised FSD in Europe, China, and other countries. And I think we're likely to receive that before the end of the year.
Thank you.
Which will be a helpful demand driver in those regions, obviously.
Thank you.
Just to add to that, Travis, in terms of like, as Elon said, in terms of regulatory approval, the vehicles are governed by FMVSS in the US, which is NHTSA, which is the same across all 50 states. The road rules are the same across all 50 states. So creating a generalized solution gives us the best opportunity to deploy in all 50 states reasonably. Of course, there are state and even local municipal level regulations that may apply to, being a transportation company or deploying taxis. But, as far as getting the vehicle on the road, that's all federal, and that's very much in line with what Elon was just suggesting about the data and the vehicle itself.
And to add to the technology point, the end-to-end network basically makes no assumption about the location. Like you could add data from different countries and it would just like perform equally well there. There's like almost like close to zero US specific code in there. It's all just the data that comes from the US.
Yeah, to that end, Ashok, it's like, we can go as humans to other countries and drive with some reasonable amount of assessment in those countries. And that's how you design the FSD software.
Yeah, exactly.
Great, thanks guys. The next question comes from George from Canaccord. George, please go ahead and unmute yourself.
Hi, everyone. Thank you for taking my questions. Maybe just to expand on the regulatory question for a second, and I could be comparing apples and oranges, but GM canceled their pedalless, wheelless vehicle, and according to the company this morning, their decision was driven by uncertainty about the regulatory environment. And from what we understand, and again, maybe I'm wrong here, but the robo-taxi that has been shown, at least in images of the public, is also pedalless and wheelless. Is there a different regulatory concern just if you deploy a vehicle like that doesn't have pedals or a wheel, and may that be different from just regular FSD on a traditional Tesla vehicle? Thank you.
Well, obviously, the real reason that they canceled it is because GM can't make it work, not because of regulators. They're blaming regulators. That's misleading of them to do so, because Waymo is doing just fine in those markets. So it's just that their technology is not up to par.
Right. And maybe just as a follow-up, I think you mentioned that FSD take rates were up materially after you reduced the price. Is there any way you can help us quantify what that means exactly? Thank you.
Yeah, I mean, we've shared we've seen a meaningful increase. I don't want to get into specific because we started from a low base, but we are seeing encouraging results. And the key thing here is, like Elon said, you need to experience it because words can't describe it till the time we actually use it. And that's why we are trying to make sure that every time a car is getting delivered, people are being showed how this thing is working, because when you see it working, you realize how great it is. I mean, just to give you one example, so again, there's a biased example, but I have a more than 20-mile commute into the factory almost every day. I have zero interventions on the latest stack, and the car just literally drives me over. And especially with the latest version, wherein we're also tracking your eye movement, the steering wheel nag is almost not there, as long as you're not wearing sunglasses.
Well, we're fixing the sunglasses thing. It's coming soon. So you will be able to drive. You'll be able to have sunglasses on and have the car drive.
Yeah.
But there's a fair number of times I've talked with smart people who like live in New York or maybe downtown Boston and don't ever drive, and then are asking me about FSD. And I'm like, you can just get a car and try it. If you're not doing that, you have no idea what's going on.
Thank you. The next question comes from Pierre from New Street. Pierre, please unmute yourself.
Hey guys, thank you for taking my question.
He always has trouble unmuting.
Again, and I completely get it that with a universal solution, we will get like regulatory approval, we'll get there eventually, clicking up miles and compute, etc. And my question is more, how you think about deployments? Because I'm still like, I'm thinking once you have a car that can drive everywhere, that can replace me, it can replace a taxi. But then to do the ride-hailing service, you need a certain scale. And that means a lot of cars on the road. And so you need an infrastructure to just maintain the cars, take care of them, etc. And so my question is, are you already working on that? Do you have already an idea of what like your plan to deploy looks like? And is that like a Tesla only plan, or are you looking at partners, local partners, global partners to do that? And I'll have a quick follow-up.
No, this would just be the Tesla network. You just literally open the Tesla app and summon a car, and we send a car to pick you up and take you somewhere. We'll have a fleet that's, I don't know, on the order of 7 million that are capable of autonomy soon. In the years to come, it'll be over 10 million, then over 20 million. This is immense scale. And the car is able to operate 24/7, unlike the human driver. So the capability to, like, there's this basically instant scale with a software update. And now this is for a customer-owned fleet. So you can think of that as being a bit like Airbnb. Like, you can choose to allow your car to be used by the fleet, or cancel that and bring it back. It can be used by the fleet all the time. It can be used by the fleet some of the time, and then Tesla would share in the revenue with the customer. But you can think of the giant fleet of Tesla vehicles as like a giant sort of Airbnb equivalent fleet, Airbnb on wheels. Then, in addition, we would make some number of cars for Tesla that would just be owned by Tesla and be added to the fleet. I guess that would be a bit more like Uber. But this would all be the Tesla network. And there's an important clause we've put in every Tesla purchase, which is that the Tesla vehicles can only be used in the Tesla fleet. They cannot be used by a third party for autonomy.
Okay. And do you think that scales like progressively, so you can start in a city with just a handful of cars and you grow the number of cars over time? Or do you think there is like a critical mass you need to get to be able to offer like a service that is of competitive quality compared to what like Uber would be typically delivering already?
I guess maybe I'm not conveying this correctly. The entire Tesla fleet basically becomes active. This is obviously, maybe there's some number of people who don't want their car to earn money, but I think most people will. It's instant scale.
Thank you. Our next question comes from Colin from Oppenheimer. Colin, please unmute yourself.
Sorry about that, guys. I've got two questions around energy storage. With the tight supply and the stationary storage, can you talk about your pricing strategy and how you're thinking about saturation in given geographies, given that some of these larger systems are starting to shift wholesale power markets in a pretty meaningful way quickly?
So we are working with a large set of players in the market, and our pipeline is actually pretty long, and there's actually long end in terms of where you enter into a contract to where delivery starts happening. And so far we have good pricing leverage, and I'll have Mike chime in on this too.
Yeah, there's a lot of competition from Chinese OEMs, just like there is in the vehicle space. So we're in close contact with our customers and making sure that we're remaining competitive in where they're needing to be competitive to secure contracts to sell power and energy in the markets. We had a really strong contracting quarter and continue to build our backlog for 2025 and 2026. So we feel pretty good about where we are in the market. We realize that competition is strong, but we have a pretty strong value proposition with, offering a fully integrated product with our own power electronics and site level controls. So,
yeah, and again, the aspect which people do not fully understand is that there's also a whole software stack which comes with our Megapack.
Right.
And that is a unique proposition which we have, which is only available to us, and we're using it with other stuff too. But that gives us a much more of an edge as compared to the competition.
Yeah, we find customers that they can sort of put together a hodgepodge solution, and then sometimes they'll pick that solution, and then that doesn't work, and then they come back to us.
Yeah, and we're not really seeing saturation for like on a global scale. There's little pockets of saturation in different markets, but we're more seeing that there's markets opening up given demand that just continues to increase more than anyone expects. So that just opens up markets, really across the world in different pockets.
Yeah, I mean, just even on the AI compute side, right? These GPUs are really power hungry, and the amount of new pipeline which we're getting for people for data center backup and things like that is increasing at a pretty large scale.
Yeah.
Thanks so much. And then the follow-up here is around the 4680 process technology, and the roll-to-roll process. There's some news around your equipment suppliers. Can you talk about how far along you are in potentially qualifying an incremental supplier around some of the steps?
Yeah, I can talk about that. As you're probably referring to the lawsuit that we have with one of our suppliers. Look, I don't think this is going to affect our ability to roll out 4680. We have very strong IP position in the technology, and the majority of the equipment that we use is in-house designed, and some of it's in-house built. And so we can take our IP stack and have someone else build it if we need to. So that's not really a concern right now.
Yeah, I think people don't understand just how much demand there will be for grid storage. They really just the people, I think, are underestimating this demand by probably orders of magnitude. So that the actual total energy output of, say, the U.S. grid is, if the power plants can operate at steady state, is at least 2 to 3 times the amount of energy it currently produces, because there are huge gaps. There's a huge difference in the from peak to trough in terms of energy or power generation. So, in order for a grid to not have blackouts, it must be able to support the load at the worst minute of the worst day of the year, the coldest or hottest day, which means that for the rest of the time, the rest of the year, it's got massive excess power generation capability, but it has no way to store that energy. Once you add battery packs, you can now run the power plants at steady state. Steady state means that basically any given grid anywhere in the world can produce, in terms of cumulative energy in the course of a year, at least twice what it is currently producing. In some cases, maybe 3 times.
All right, thank you.
This is a very profound thing.
Great. Thank you, Elon. The next question comes from Colin Langan from Wells Fargo. Colin, please unmute yourself.
Oh, great. Thanks for taking my questions. Do you hear me?
Yeah.
Yeah. Oh, okay, good. Sorry. I guess we're going to ask, if Trump wins, there's a higher chance that IRA could get cut. I think, Elon, you had commented online that Tesla doesn't survive on EV subsidies. But when Tesla lose a lot of support if IRA goes away? I think Model Y, 3 and Y get IRA help for customers, and I think your batteries get production tax credits. So just one, can you clarify if IRA ends, would it be a negative for your profitability in the near term? Why might it not be a negative? And then, any framing of the current, support you get IRA related.
I guess that there would be like some impact, but I think it would be devastating for our competitors, but and it would hurt Tesla slightly. But long term, probably actually helps Tesla. Would be my guess. But I've said this before on these calls. The value of Tesla overwhelmingly is autonomy. These other things are in the noise relative to autonomy. So I recommend anyone who doesn't believe that Tesla will solve vehicle autonomy should not hold Tesla stock. They should sell their Tesla stock. If you believe Tesla will solve autonomy, you should buy Tesla stock. And all these other questions are in the noise.
Yeah, I mean, I'll add to this just to clarify a few things, that at the end of the day, when we are looking at our business, we've always been looking at it whether or not IRA is there. And we want our business to grow healthy without having any, subsidies coming in, whichever way you look at it. And that's the way we have always modeled everything. And that is the way internally also, even when we're looking at battery costs, yes, there are manufacturing credits which we get, but we always drive ourselves to say, okay, what if there's no IRA benefit? And how do we operate in that kind of an environment? And like Elon said, we definitely have a big advantage as compared to our competition on that front. We've delivered it, and you can see it in the numbers over the years. So there is, you cannot ignore the fundamental sides of the business. And then on top of it, once you add autonomy to it, like Elon said, it becomes meaningless to even think about the short term.
Okay. I think that's unfortunately all the time we have for today. We appreciate all of your questions. We look forward to
full summary coming in a second.
Thank you very much and goodbye.
Thanks, man.
Well, they dipped out of that fast. Okay, all right. Let's do a full summary. We'll go Tesla, Google, market, blah, 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 blah. All right. Remember, coupon code meetkevin.com. Gave all of my strategies for this earnings season in that course member live stream this morning. So let's just put it this way. I was trimming Tesla. But anyway, let's get into what happened with the earnings call. And we'll touch a little bit on Google and Tesla. So here we go. Okay, turn that down a little. All right. So, well, Google and Tesla just reported earnings, and they might be the catalyst for pushing the market over the edge, and not in the way that we want it to go right before election season. Let's get started with what the heck just happened. First of all, sort of an intro here. The expectation and concern was that we might hear something about slower artificial intelligence revenues, slower growth combined with higher valuations and the election. And well, that's kind of what we got. Google confirmed a slowdown or more patience being required before seeing AI profitability. Keep in mind, quality of their products is increasing and the output of their AI innovation is increasing. We'll talk more about that in just a moment. And Tesla complained that NVIDIA chip demand is so high that they're basically forced to make their own Dojo chips, which once again reiterates that Dojo is more of a side project. Even though Elon does think Dojo will be competitive at one point with NVIDIA, they still need their NVIDIA chips. And despite all of this, NVIDIA stock is down about 1.5% in the post-market. Now, that could change and fluctuate rapidly, and it seems like demand should still be pretty dang well there for NVIDIA, especially with what we heard from Tesla. But the question now is, what are the details of what happened here, and could this lead to an AI sell-off? I'll start broadly. Yes, this earnings season could lead to a market smaller kind of correction before the election, but I've had that thesis for about a week and a half to 2 weeks now, and what I've been doing is I've been trimming positions. In my course member live streams, I've been explaining my positioning. I'm about a 5 out of 10 on the bull-bear scale, and I've increased the cash positioning in the fund that I manage to up to about 30%. It's somewhere between 24 and 30%. We also trimmed our Tesla exposure by more than 50% going into these earnings. And we talked to course members this morning about the concerns going into these earnings. Some of those concerns that we talked about going into this earnings were that we kind of already had a little bit of a short squeeze over the last period where Tesla ran up to 265. We also talked about how, it's right here. This is kind of like just slapped together some notes. This was our course member live stream this morning. And we talked about Robotaxi, the delay killing momentum. Robotaxi event likely to be buy the rumor, sell the news. Going to be years before Robotaxi is commercially viable. Euphoric pricing implies that these are all right around the corner, but they're not. And today for the stock what you really need is even better margin in Q1. A lot of that, unfortunately, we saw in the earnings came from regulatory credits. A return to free cash flow, though look at this, I even wrote the market's pricing in 1.9 billion in free cash flow, and I wrote, yikes, that's a huge ask. And sure enough, we missed on that free cash flow. We have to beat market enthusiasm to justify maintenance of 250, which I didn't think it was going to happen. And Elon will be drilled about Robotaxi. Sure enough, this is what happened. And this isn't the place for announcements. Sure enough, that's exactly what he said. Although we did get a few insights, none of them enough to actually create any kind of sustained euphoria. And therefore, I wrote, can it rally? Of course, but I lean towards not. And that's why I went in trimming going into this earnings release. So what did we hear? Well, let's get into some of the details. Quick shout out, we got prices going up on the courses on building your wealth soon, so check those out at meetkevin.com. Bundle coupons, email us at staff@meetkevin.com. We've got a mastermind at meetkevin.com/mastermind. That's really popular. We've got small groups and private one-on-one masterminds now, so check those out at meetkevin.com/mastermind. And architect and structural engineers. If you are an architect or a structural engineer and you want to relocate to California, we'll pay your relocation, pay you a great salary. Even if you're both, gosh, but we'd hire separately as well. Like a licensed architect, licensed engineer will help you get licensed out here in California. We need you. Send us a jobs request, send us a resume and sort of a 60-second pitch on you to jobs@meetkevin.com. Structural engineer and architect. Could be two separate people. All right, folks, let's get into it. Tesla regulatory credits increased 3x year over year, 2x sequentially from Q1 all the way up to $890 million. This is remarkable, and it's in part because what you're seeing is a reduction in, well, frankly, other OEMs competing for these regulatory credits as they're leaning away from, well, quite frankly, you're leaning away from producing electric vehicles. Interest rate buy-downs helped drive the production and delivery numbers that we saw in Q2, but I worry that this is a little bit of what I call a good kitchen sink quarter. In other words, it happened to be the best quarter for Elon to have his stock comp plan vote. And so what did we get in that quarter? CapEx reduction, now it's ramping again in Q3. Production reduction, now it's ramping again in Q3. Interest rate buy-downs, and those are also here in Q3, which is lowering the average selling price of these vehicles. Your average selling price right now is down to about $44,774. And it does look like the average selling price is reflective of the interest rate buy-downs. So those interest rate buy-downs are coming off that top line, apparently. Anyway, you've got a lot of expenses that are still coming later this year. You do have a lot of cash. You've got over $16 billion of free cash. Now, about $2.5 billion of that did come from debt that they just raised. But you definitely have expenses that are going to grow in the rest of the year. They still, and they reiterated, they still expect to spend $10 billion in CapEx. And given that they slowed down their spending in Q2, it means we got a lot of spending ahead of us. Supercharger growth slowed to just 3.5% sequentially, which annualizes to about 14%, which is down about 10 percentage points year over year. This isn't great. This might lead to more congestion as Tesla invites other charging customers to use Tesla's supercharging network. So you would actually expect the supercharger network to grow faster, not slower. Not seeing that at the moment. The Tesla did start delaying some of the rollout to some of these other third-party OEMs, and you did end up seeing some of the Tesla supercharging team rehired. Tesla's still focused on cost reductions. They were actually pinged on this. They're like, why are you focusing on cost reductions if you're trying to grow more? The same question came up about Giga Mexico, which I actually thought the answer was pretty interesting about this. We knew that Giga Mexico was on pause, but why was interesting. It was previously on pause because macro is concerning. Now it's on pause because, well, if we manufacture more outside the United States, like in Mexico, we could get screwed by tariffs via a President Trump administration, which is also interesting because we have essentially Elon himself has confirmed that, yes, he is donating about $45 million to a super PAC that is his, which is supporting Donald Trump for president. Anyway, margin beat at 18%, but again, that margin growth mostly moved because of that expansion in regulatory credits, so not great. Increased deliveries from Shanghai, that's good. Audible's now available in the car, fine. More affordable options remain on track for 2025, and they are expected to be built on the same manufacturing lines as current vehicles. Only the robotaxi is supposed to use the unboxed method of manufacturing. This is where you're not going down an assembly line, but rather multiple parts of the vehicle are being assembled by, let's say, Optimus robots at the same time. Energy may continue to grow at a faster pace than cars. That's exactly what we're seeing right here. You did get a profit miss, EPS miss. Again, this is the fourth straight time in a row. Tesla is also likely to go negative year over year on vehicle deliveries. Elon on the conference call says competing electric vehicles haven't done well. They do expect, again, that more affordable model to begin production in the first half of next year. And it sounds like one of the reasons they delayed the robotaxi event to 10/10, October 10th, which is a momentum buzzkill, which isn't great for the stock, is because they want to introduce other models at that moment as well, which could be the lower cost model. And we also got a hint on the Roadster here, that the Roadster announcement might be coming for production next year, so you could see something at the Robotaxi event as well for the Roadster, higher-end vehicle. Now, I personally have what I call I call it my, this is inspired by Rust, it's a video game, sorry. I call it my 2x2 foundation for investing in stocks. And the 2x2 foundation is built on 4 premises: valuation, pricing power, sentiment and momentum, and bankruptcy risk. Tesla does not have bankruptcy risk. However, Tesla's valuation is very high. Before this earnings report, we were sitting at a 3.1 peg for the next 4 years of growth at 32% EPS growth priced in. That's expensive. That's because the PE ratio right now sits for this forward year at 100. Now, obviously, you're going to have about a 7% discount to that now, given that the stock is falling 7%. The valuation is very high for a manufacturing company, though, which should be closer to about a 1.67 peg. Pricing power in the industry, though pricing power in general for autos is substantially weaker than pricing power at other companies. Sentiment and momentum just got buzzkilled, and again, I don't think there's bankruptcy risk here. So you're really missing 2 of these foundations, right? The valuation is high, they do have in-class pricing power, they don't have bankruptcy risk, but sentiment and momentum really started dying after that robotaxi event got killed. And unfortunately, this earnings call is probably just going to accelerate sentiment in the negative direction, which isn't great. So near-term pricing, not super excited about it. Again, there's a reason why I reduced my exposure to it by over 50% leading into this earnings report. And we've been talking about this and sending alerts about this in the course member live streams and talking about this as well. But anyway, continuing on. Elon believes we have the scale and production capabilities to be the most efficient EV producer in the world, and that will be really useful for Optimus production. I just want to be clear, as much as I love the whole idea of robotaxi, and as Elon puts it, the Airbnb on wheels, introduce your car to the fleet, we've heard all this crap before, we're not there yet. And I understand the market can get really enthusiastic about pre-pricing in these things, but until we actually see revenue, it's almost impossible to price it in and to stand on that valuation, because we haven't gotten to full self-driving unsupervised yet. We're still trying to get to, more than a few miles between interventions. And it's probably going to take years before we get there. This doesn't mean I'm bearish long-term Tesla, but short-term, it's not good. You don't want to price in Robotaxi. You don't want to price in Optimus in the short term. Yes, Optimus was doing something productive. They alluded to initially in their press deck release, and then in their slide deck release. It's funny because I joked, and you can fact check me on this. I joked about it live. I'm like, what, are they going to have the Optimus putting batteries in a box? Because they're like, oh yeah, we have the Optimus working with batteries. And well, I'll just let you look on screen, and yeah. Anyway, 12.5 release for FSD should be a big shift. Now we're going to merge the highway and city stack. That's great. This idea about other OEMs using FSD has once again resurfaced in the earnings call. I'm tired of hearing this. They literally say, yeah, other OEMs have expressed interest. They've been saying it for over a freaking year now. I'm overhearing it. It ain't happening. Especially when you have the CEO at Ford going, we're going to make money with software. They want their own crap. And guess who's going to give them their own crap? NVIDIA. You could literally just take the NVIDIA Drive platform and plug it into your garbage at Ford and build your own software rather than paying Tesla for it. I'm not saying it's going to be close, but in 5 years, they're all going to have their own FSD, and they're all going to use their own crap. This OEM stuff, licensing Tesla FSD, I put a 1% chance on it happening. And if it happens, by all means, I will eat my words. I was wrong about Google, mind you, and we're going to talk about Google in just a moment. They really impressed, so I absolutely can be wrong, and I guarantee you I will be wrong in the future again. I'm just saying, I'm highly confident this whole OEM licensing thing is bullshit. Sorry. Anyway, Optimus is already starting to perform whatever, this is nonsense. Eventually, yes, he expects that Optimus will be able to perform tasks inside of the facility at Tesla for Tesla, and that they'll have maybe 1,000 Optimus robots doing things practically inside the facility. So that'll be Optimus version 1, and they expect to get to Optimus version 2 in 2026, which maybe third parties can then license, rent, or buy. Long-term, Optimus achieves ARK's valuation several times over, says Elon Musk, but again, that implies that you don't have substantial robot competition, which you will also have a substantial amount of robot competition. Anyway, when do you expect the first Robotaxi ride? The answer was, depends when we can get to unsupervised FSD. So it doesn't actually sound like Robotaxi is anything other than just, here's a car that uses FSD. So if you really want to know how well FSD is going, you just need to own a Tesla and then watch the FSD upgrades. Now, I want to be clear. FSD is really good. When I drive, I use it all of the time. So I'm a big fan of it, and it's gotten better. You know, some of the first versions of 12, like 12.1, 2, 3, weren't that great. 12.4 is fantastic. I absolutely love it. So don't get me wrong, it's great. Is it going to be driving itself anytime soon? No. Next, we've got this potential Osborne effect Elon was talking about, which is where people cancel their current orders because a new product is announced, and that's why he doesn't want to announce any kind of new product yet. Sure. Okay, Elon. Let's see here. FSD in Europe is well behind, working on approvals to get supervised FSD in Europe and China, hopefully by the end of the year. In the future, you'll be able to open up your app and we'll send a car to come pick you up. I understand this ARK thesis that, you know, you're going to get 25 cents per Robotaxi mile or whatever. I also think that is broadly bull SH9T. The reason for that is I think if literally everyone who owned a Tesla in every city submitted their car to the Robotaxi network when they weren't using it, the value of a taxi will plummet. The cost will compress so frickin' rapidly, you'll barely make a dime over your cost vehicle depreciation, charging costs. That is going to compress instantaneously. Now, that'll destroy Uber and Lyft, but I think you still got a few years for that. All right. Google. So, okay. Google, I actually have to say I'm really impressed with. Oh, yeah, anyway. So, short-term bearish Tesla. Longer term, I like it, but I'd like it cheaper. So, yeah. You really also need to get back over 230. Otherwise, on a technical basis, you're going to probably go back under 200 for Tesla. Anyway, it's something I've been warning about for a few weeks in the course member live streams as well. People keep asking me like, oh, what's going on with Tesla? I go, it's going to go down. Like Q3, Q4, by then it's going to go down. It might happen a little sooner than we thought. This isn't me being bearish. I'm just trying to be realistic. And then you go back and get the receipts. Anyway, when you join those courses, mind you, you get all my course member live streams going all the way back to like 2017. So you just pick my brain all throughout the evolution. It's kind of cool. Google wants to bring AI to everyone. You know, they're trying to do a very similar to Apple thing. It's like, oh, what did I eat in that restaurant at Paris last year? I don't know why that's super functional, but whatever. I guess it's cool. It sounds very Apple-esque. What they're finding is that they're able to increase efficiency for advertisements. For example, their PMax product, which is Performance Max, it's what you could set your ad account to. It converts 25% better than the non-PMax version. That's AI. PMax uses Google's AI. So what you're finding is AI is just making products better. Quality of products is going up. Costs are going down within companies. But they're not really driving incremental revenues. They're not necessarily increasing the revenue line. They're just decreasing costs and making all products better, like more functional and useful for end users, which is a good thing. Like net, AI is great, but is it really going to be this revenue windfall everybody's expecting? Probably not in the very near term. And at some point, we don't know when that is. It could be, quarters from now. It could be years from now. At some point, the costs of AI chips will collapse because the AI infrastructure will be built out. YouTube, second most watched after Disney for streaming. YouTube's benefiting from connected TV. YouTube benefits from more advertisers as well. Search remained the largest contributor to revenue growth, retail search specifically. And they are really kicking butt because they're integrating Gemini right into Google. I actually think this was well played. I was wrong on this. I thought people would just use AI search apps as opposed to Google and it would replace it. But frankly, Google 4D chessed this and just basically built the AI search results right into search. And now they put ads above and below it, and they're expecting to have product ads within the AI results. Brilliant. Absolutely brilliant. Hands down, loved what I heard from Google. Loved what I'm seeing from Google. I'm a Google Cloud user. All my companies use Google. We're big fans. 32% operating margins. YouTube subscription revenues are growing. Healthy watch time. Much slower pace of hiring with a slight pace of growth going into Q3. This is great. That's anti-recessionary. You don't want to hear more layoffs. They're already negative like 2,000. It's about 1% smaller workforce than what you had year over year. And you are growing. So that's good, but it shows you're kind of on a little bit of a teeter there, right? Planning to invest $5 billion into Waymo's self-driving car unit. They're committed to privacy, but they're not getting rid of cookies yet, which I'm not really sure how that is going to affect Trade Desk, because getting rid of cookies was kind of what Trade Desk was really excited about with UID 2. This is their sort of solution to cookies. But then again, maybe you can get better data if you do have access to cookies. So it could just be a net neutral there for Trade Desk. So, but anyway, yeah, it seemed like markets reacted pretty negatively to this idea that you weren't going to get more revenue from AI. Enphase, despite a 19.5% miss on microinverter shipments, the stock is remarkably up 4.5% in afters. I think people were expecting the worst. They were expecting a big collapse, so hence the stock is up. And they indicated that customer demand is up 5% in Q2, that 85% of Q3 shipments are already booked. Inventory is normalizing, the sales channel, and sales outside of California is flat. Sales are up 7% in Q2 outside of California. So for me, if I'm looking for buy the dip, maybe it's Enphase, or honestly, it's just waiting, because I think there's a chance going into this election, you're going to want a little bit of a cash buffer. And that's why I've been increasing. Like, I put my money where my mouth is. I can't advertise my fund in here. I'm not trying to advertise my fund in here. I use it it's my own sort of tool. I love it. I think it's fantastic. But I just put my money where my mouth is there. So that's sort of a long-term vehicle. And when I see opportunities for short-term balancing, I do that. So I like building cash. And then when the market dips, bang. I personally think broadly, not personalized advice for folks, now might be an opportunity for some cash building. So with that said, let's go ahead and pull up the sticks here. Tesla now down 7.91%. I want you to see we lost the 250 support. This was a really critical line. We got rejected there mostly throughout the day. Was able to also make some profitable, well, actually we had one profitable, I only made one trade today. But anyway, profitable trade today. If you want all my short-term or long-term buy-sell alerts, can't guarantee you'll make money, but you'll get all my perspective. Make sure you join the Stocks and Psychology Money Group. Any of the courses on building your wealth will give you access to the course member live streams for life, including all the TA we talk about, short-term, long-term alerts, the Discord community, you name it. Tesla's almost down 8% here. The next support level right now is sitting about 225. And if we lose these 220s, unfortunately, we're going to be back to the 195s. So watch these levels here at Tesla. NVIDIA down after that Google earnings call, and NASDAQ futures also down 0.5%. Bitcoin is sitting roughly around the levels that we saw when Biden resigned. I think there could also be some near-term risk-offness in the Qs that spills over to Bitcoin. Google negative about 1.76, 1.8, so not too much of a big move here on Google. However, it is getting rejected by that 194 line. You can pretty much see that perfect rejection here. Next stop is 152. If we do start a downtrend, I don't think Google's earnings were bad enough to really support that kind of downtrend. You'd really need a larger market correction, but we might end up getting that. So there you go. Thank you so very much for watching. Really appreciate y'all. Remember, we've got that amazing mastermind. It could be one-on-one in person or small group with C-level executives from companies who are in it, business owners, real estate investors, hoteliers, you name it. You want to be in it. Check it out at meetkevin.com/mastermind. That is a higher ticket option. The next, the best option I think everybody should be a part of are those course member live streams and what you get in those courses on building your wealth at meetkevin.com. Thank you so much for watching, and it's disclaimer time. Even though I'm a licensed financial advisor, real estate broker, and becoming a stockbroker, this video is neither personalized financial advice nor real estate advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show should not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purpose of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services which we may benefit from. I personally operate and actively manage ETF and hold long positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuers other than HouseHack, nor am I presently acting as a market maker.